Many of us have watched China for years, appreciate that the magnitude of the economic challenges China must address now are not new. Rather, they have been worsening for years and were amplified by COVID and the poor policy choices made during that time. Notwithstanding the CCP's push for Chinese households and non-state businesses to drive recovery in 2023, household consumption has been cautious. Government lending practices continue to favor unproductive state-owned enterprises, higher-performing non-state sector, at the expense of higher-performing non-state sectors. In most cities, property prices have plunged, and business confidence has eroded as deflation sets in. 2 years ago, we reported on the rising concerns related to debt and demographics. Those challenges are only intensifying. Over the past decade, China's banking sector has grown from 9 trillion to a staggering 56 trillion in assets. Those assets are somewhat questionable. By the end of 2022, China's debt-to-GDP ratio exceeded 297%, more than double what it was in 2008. This unprecedented expansion in credit largely flowed into a building boom that contributed roughly 30% of GDP. More troubling in terms of the human dimension of the problem, in terms of economic instability and political confidence in the CCP, roughly 70% of household wealth is tied up in the real estate sector, which experienced across the board significant declines in sales, starts, and land purchases for building. China simply cannot sustain the policy approach of credit expansion, nor will it be able to continue to shield unproductive entities from default. After 20 years of relying on debt-fueled stimulus, China confronts twin challenges of lacking viable infrastructure projects sufficient to stimulate growth, and developers and local governments overburdened with debt. Whether local governments and the opaque funding vehicles they create to raise money are stable and sustainable is very much in doubt. A recent report indicated 43 LGFBs failed to redeem maturing commercial paper. Was this due to a lack of investor confidence? Adding to these significant challenges, by mid-23, China's official youth unemployment rate had soared above 21%, at which point the party of state abruptly stopped releasing data. Although transparency into China's economic data is vanishing, the country's economic weakness is now far too pronounced for the CCP to hide. For years, we talked about shadow lending as a challenge. Now the problem is shadow data. International investors cannot have confidence in buying stock on U.S. exchanges or directly investing in China if data are inadequate, misleading, overstated, censored, or withheld. Our fabulous witnesses today have deep and diverse expertise researching China's domestic economy and supply chain policies. I'm pleased that 4 or 5 have not previously testified before the Commission and bring forward new perspectives on key elements and outcomes of China's economic model. I'll now hand it over to my co-chair for the hearing, Commissioner Glass, who will introduce the panels and make some compelling remarks.
Thank you, Commissioner Cleveland, and good morning, everyone. Today's hearing will call into question the health of China's economy and the overall implications for the CCP's influence over technology supply chains. The party's state dual circulation strategy aims to eradicate its own external vulnerabilities while increasing the world's dependence on Chinese technology. Today, U.S. policymakers are moving to address some of the risks stemming from supply chains that are overly dependent on China. However, much more remains to be done. In May of this year, the Biden administration announced that the United States aims to de-risk its relationship with China, focusing U.S. policy on fortifying areas core to U.S. national and security interests. Congressional action through the Inflation Reduction Act and CHIPS and Science Act took major steps towards diversifying U.S. supply chains in semiconductors and clean energy technologies if implemented properly. Nonetheless, these efforts are still early, and further action is needed to reduce U.S. other vulnerabilities to Chinese control over critical supply nodes, from pharmaceuticals to green energy. The recent spike in Chinese electric vehicle production and exports exemplifies the party state's ongoing efforts to expand control over crucial segments of global production. U.S. businesses are discussing options to de-risk their own operations, but China is simultaneously moving to ensure U.S. companies and investors remain intertwined with Chinese markets. While a 19% drop in trade with China and a nearly 90% drop in foreign investment in China in the previous quarter may be seen as a signal of decreasing reliance on Chinese markets, overseas investments by Chinese companies simultaneously surged. Chinese companies are looking to offshore production to other countries in Southeast Asia and even Mexico, evading tariffs by locating production in other jurisdictions. They are also continuing to export through other secondary markets to avoid tariffs and also customs scrutiny under the Uyghur Forced Labor Prevention Act. As a result, even where trade data shows a decrease in direct U.S. dependency on China, the true value of Chinese content in U.S. supply chains is much higher. This hearing provides an opportunity to consider the kinds of guardrails that businesses can follow to address these increasingly complex supply chain risks. Before we begin, I'd like to remind you all that the testimonies and transcript from today's hearing will be posted on our website. I'd also like to thank the Senate Committee on Health, Education, Labor, and Pensions for securing this room for our use today, and the Senate Recording Studio for their assistance in live streaming this event. We'll now begin today's hearing with our first panel. I've had the honor to introduce our first panel today. Our first panel will provide an overview of the economic and financial challenges confronting China today. We will also explore how these issues impact the global economy and how investor sentiment toward the country is changing. We'll start with Dr. Logan Wright, who is a partner at Rhodium Group and leads the firm's China market research work. His testimony will provide an overview of China's economic and financial challenges. Next, we'll hear from Mr. Nicholas Borst, who is appearing virtually. Mr. Borst is Vice President and Director of China Research at Seafarer Capital Partners, and he will discuss China's fiscal challenges and investor sentiment. Finally, Dr. Zhang Nguyen Zoe Liu, and I hope I'm pronouncing that somewhat correctly, will provide her testimony. And please correct me. Dr. Liu is the Maurice R. Greenberg Fellow for China Studies at the Council on Foreign Relations, and she will address the role of state-owned capital, particularly China's sovereign wealth funds, in financing the country's domestic and overseas ambitions. Thank you all so much for your testimony and appearing before the Commission today. We all look forward to hearing your remarks. I ask all the witnesses to please keep the remarks to 7 minutes. Dr. Wright, we'll begin with you.
Thank you, Commissioner Cleveland, Commissioner Glass, all the commissioners and staff for your kind invitation to testify at this important hearing today. My testimony focuses on 3 principal arguments related to developments in China's economy and financial system and their implications for the United States. First, the severity of China's ongoing economic weakness is still widely underappreciated, and the United States no longer faces a growth challenge from China. Beijing is no longer an economic pacing threat or likely to overtake the United States in any significant measure of economic power in the next 2 decades, assuming U.S. growth continues at roughly current rates. Beijing will never be able to make a credible claim to global economic primacy. The challenges the United States faces in strategic competition with China are highly significant, but they will not be impacted by marginal changes in China's economic performance in the years ahead. China's current economic slowdown is structural in nature. Simply put, most of the factors that contributed to China's rapid growth over the last 2 decades cannot be repeated in the next decade. These include an expanding labor force, unprecedented credit and investment growth, a booming property sector, a one-time buildup of infrastructure, and a constructive external environment. Most analysts agree that growth in China will not recover to its previous rates, but there's still considerable disagreement about how severe the slowdown will become and the implications of those changes for the United States. One of the least understood aspects of China's economic record over the past decade has been the linkage between the rapid growth of China's financial system and its economic performance. China's current economic slowdown is structural primarily because the credit and investment expansion that took place from 2008 to 2016 was also unprecedented. This was the largest single-country credit expansion relative to global GDP in over a century. Credit growth of this magnitude not only powered significant volumes of local government investment and property construction, but most importantly, it provided a shock absorber insulating China's economy from bankruptcies, defaults, and unemployment. And that credit expansion has ended. China's economy, as measured through GDP in 2022, is around two-thirds the size of the U.S. economy in dollar terms, 65% at current exchange rates, even based on China's suspect official data. Given China's long-term economic challenges, there is no realistic scenario in which China's economy becomes 150% or 200% of U.S. GDP in the future, surpassing the United States by a wide margin. The United States will continue to be challenged by China's military buildup related to Taiwan and the South China Sea, China's outsized and politicized influence within specific next-generation industries and manufacturing supply chains, economic policies artificially boosting Chinese firms' competitiveness, and behavior to influence democratic political systems around the world. Those problems are exactly where U.S. policy and legislative efforts should focus. But none of these military, diplomatic, or ideological areas of strategic competition with China will be changed by marginal adjustments in China's economy from current levels, even if China were to improbably reach the level of U.S. GDP. And China's slow pace of economic growth is more likely to weaken Beijing's capacity to confront the United States and its allies in these areas, rather than rapid economic growth boosting China's capabilities over time. Second, Beijing is attempting to downplay public recognition of China's economic slowdown, both inside China and internationally. The most important propaganda message for China's leaders related to the economy is that the argument that China's economic rise is inevitable and that this will reinforce China's rise in great power status. Chinese leaders believe they can influence the narratives about the economy through conventional domestic propaganda, but also by restricting the availability of economic data and stories they dislike. China's economic data, meaning the data points likely to generate media coverage such as GDP growth, should be understood as critical elements of China's internal and external narrative management concerning the economy. Tighter controls over data and censorship of discussion of China's economy should also be understood as reactive responses to real uncertainty among economic actors in China about Beijing's policymaking. The narrative about China and its economy is important to the United States. The success or failure of Beijing's policymaking in an estate-driven economic model determines not just the relative performance of these two competitors, but the attraction and hence the global soft power of the Chinese system and its ability to displace commitment to traditional liberal democratic and market economic norms. Third, the property and local government debt crises in China are intrinsically linked. As credit growth slows, investment growth will follow, and significant proportions of that credit and investment have been channeled into property construction and infrastructure over the past decade. Property developers delayed a long-anticipated slowdown in the industry by relying upon increasingly risky forms of financing, such as the proceeds of housing sales before actual construction took place. This introduced a Ponzi-type element into the financing of China's property sector. As sales suddenly declined, a trend that was exacerbated by lockdowns in major cities in 2022, property developers not only struggled to complete construction of homes they'd already sold and promised to deliver, but also stopped buying new land from local governments. Local governments' fiscal revenues are heavily dependent upon these land sales, and the sudden loss of revenues has made it far more difficult for localities to service debt accrued during the last decade, as this investment was not funded directly by fiscal spending. The property sector's adjustment has been severe. New housing starts are down over 50%, 60% from their peak, and there's no easy solution for the local debt problem without changing China's entire growth model to make it less dependent upon investment. The structural slowdown in China means that the United States can be more narrowly concerned about the national security implications of specific economic transactions, rather than whether or not a particular action will help or hurt the Chinese economy as a whole. There is a significant national security concerns related to the transfer of advanced technologies with military or dual-use applications, but there is little at stake for the United States in U.S. or allied investors buying stocks in Chinese consumer-focused companies or Chinese government bonds. Most trade and investment activity between the United States and China is mutually economically beneficial and poses no national security concerns. U.S. commitments to free market principles are a valuable asset that facilitates greater alignment among our allies and partners, many of whom will be far more reluctant to impose trade and investment restrictions upon Beijing. Given the challenges that Chinese behavior and economic statecraft poses, de-risking from China's economy is widely supported and necessary. But in a decade in which China will slow significantly independently of any action by the United States, we can more confidently keep the limits around U.S. and allied economic engagement with China narrow. Thank you.
Mr. Borst, is he online?
Yes, can you hear me?
Thank you.
Well, thank you so
Go
much.
ahead.
Thank you so much. And I'd like to start by thanking the commissioners for the opportunity to participate in today's hearing. I will relay my observations from reviewing China's recent economic data and visits to 10 different Chinese cities over the course of this year. The Chinese economy is currently in a weak position. While the economy performed well in the early years of the pandemic, growth decelerated sharply in 2022 due to lockdowns and a severe decline in the real estate sector. Since Beijing abruptly reopened the country at the beginning of the year, the economic situation has improved somewhat. However, activity is substantially weaker than many of the projections made at the beginning of 2023. China has not only failed to have a reopening boom, it is now in danger of losing economic momentum. The current state of the Chinese economy can be primarily attributed to three policy decisions made over the past several years: a failure to moderate the real estate deleveraging campaign, a crackdown on the private sector that has damaged business confidence, and a failure to adequately prepare for the post-COVID era. Equally important, the Chinese government has backtracked during this period on addressing fiscal imbalances between the central and local governments. This has created new financial risk and further hindered the country's economic recovery. The first policy mistake was the real estate deleveraging campaign. In 2020, the Chinese government decided to push ahead with a major restructuring of the property sector. A primary focus of this effort was to force property developers to deleverage their balance sheets. However, these policies soon created a severe financing crunch across the entire industry. The riskiest and most over-leveraged property developers ran into trouble first, but the financial stress soon expanded to the entire sector. No longer able to obtain financing, property developers began pausing work on new housing projects. Many Chinese home buyers who had pre-purchased apartments refused to make mortgage payments, fearing that their homes would not be completed. The government has since tried to unwind many of these policies. However, the property market remains weak and financing challenges for real estate developers have not been resolved. The second policy mistake was the crackdown on the private sector. In late 2020, Chinese regulators initiated a sweeping and unpredictable campaign that became known as the regulatory storm. Chinese social media and e-commerce platforms were forced to restructure their business models. Certain industries, most notably the private education sector, were nearly regulated out of business. China's creative industries faced stringent new censorship rules and a freeze on content approvals. The retail, payment, and consumer lending industries were put under new regulations that fundamentally crimped demand. At the same time, the Communist Party redoubled its efforts to establish party organizations within private companies and exert greater control. The cumulative effect of these new policies has been devastating for many of China's leading private firms and has contributed to the sharp decline in private investment. The third policy mistake was the lack of planning for the post-pandemic era. At the end of 2020, it became clear that effective COVID-19 vaccines were possible and that countries needed to begin adjusting their approach to the pandemic. However, China held steadfast to a zero-COVID policy that effectively sealed it off from the rest of the world. While most countries unwound pandemic controls in 2021 and 2022, Chinese authorities engaged in a series of strict lockdowns and quarantine measures. The economic damage from these lockdowns was tremendous, especially to small businesses who received insufficient government support. This has had a direct impact on high levels of youth unemployment today. And even though pandemic restrictions have now been lifted, consumers are understandably cautious and unwilling to increase their spending. Perhaps most importantly, Beijing has failed to address local government debt problems during this period. The severe fiscal imbalances between the central government and local governments are at the heart of many distortions in the Chinese economy and are the most pressing financial risks facing the country. Local governments have borrowed extensively, both directly and through off-balance sheet vehicles called LGFVs. While some of this investment may be going into useful projects such as infrastructure, there is also likely to be a significant amount of waste. Further compounding problems, most LGFVs have limited cash flows and must rely on new financing. To remain financially solvent, LGFVs must either continue to borrow or receive financial support from local governments. However, the financial condition of local governments has deteriorated due to lower land sales and high levels of pandemic spending. This has increased the risk that local governments may no longer be able to bail out struggling LGFVs, leading to an increase in defaults. China's unresolved debt problems mean that the economy is likely to continue slowing. Beijing's past approach has been to muddle through by providing support to struggling borrowers and relying on rapid economic growth to lessen debt burdens over time. However, this is unlikely to work well this time. The economy's slowing trajectory means that China cannot easily grow its way out of debt. Additionally, local governments are constrained in their ability to support the economy due to highly indebted balance sheets. If China neglects to undertake important fiscal reforms, it faces the risk of a prolonged period of slow economic growth. Fiscal reform could be an opportunity to set China on a path towards more rapid growth and address many of the core imbalances in the economy. However, I believe this course of action is unlikely given that many of the adjustments required directly conflict with the ideological priorities of the Xi Jinping government. While these issues are primarily domestic for China, I believe there are implications for the U.S. The economic challenge from China has changed. China's economy has slowed and it is unlikely to recover its rapid growth trajectory. The Chinese government is likely to be intensely focused on efforts to address its own internal economic challenges over the next several years. The party's efforts to exert greater control over the private sector have damaged some of the most dynamic and innovative parts of the Chinese economy. And Chinese local governments will have fewer financial resources to support Beijing's policy initiatives and stimulate the economy. China's economic slowdown, combined with the strong performance of the American economy, provide U.S. policymakers with a strong negotiating position. China needs foreign investment and access to overseas markets to sustain its economy. China is still one of the United States' most important export and investment markets, and improving conditions for American companies doing business with China should be a priority. The current moment is a favorable one to seek greater market access and other reforms that will directly benefit American firms and boost exports. Thank you.
Thank you. Dr. Liu?
Thank you, Chair Cleveland, Chair Glass, and commissioners, as well as all the staff members of the U.S.-China Commission. I really appreciate the opportunity today to testify in front of you with regards to the role of China's sovereign funds in finance the Communist Party of China's global ambitions. For the past 2 decades, China's sovereign funds have played a significant role in China's economy, mitigating financial crisis, and tempering exogenous shocks. They have supported China's industrial policies by financing the state's procurement of strategic overseas assets, bankrolling Chinese enterprises' mergers and acquisitions abroad, and sponsoring the development of indigenous Chinese technological startups. I would like to make 3 points today. The first point is that while the Communist Party of China first leveraged the foreign exchange reserve to establish such a sovereign funds, for what that first time was to address a domestic financial crisis in the early 2000s. But despite the first time was crisis-driven, since President Xi Jinping came to power, the Communist Party of China and the Chinese government has been more proactively using foreign exchange reserves to finance its global ambitions. And my second point is that the Chinese sovereign funds have evolved and changed their investment strategies in response to enhanced investment screening. In areas where direct investment became more difficult, they choose or they have resorted to establish joint ventures and partnerships to mitigate scrutiny risk. And my third point is that China's sovereign funds and their overseas assets are not necessarily uncompromised strengths, but actually they can be strategic vulnerabilities. And this means that the Chinese government is likely to advance the development of alternative non-dollar-based financial infrastructure and financial system to reduce their strategic vulnerabilities. Now let me elaborate on these 3 points. The first time that the Chinese government leveraged foreign exchange reserves was to create Central Huijin back in 2003. And at that time, Chinese banking system was crippled with non-performing loans. But since President Xi Jinping came to power and the rollout of the Belt and Road Initiative, or the so-called BRI, has motivated the party to leverage China's foreign exchange reserves as a strategic financial power to advance China's overseas interest. Since 2013, the party has used foreign exchange reserves to replenish Chinese policy banks, establish several new sovereign funds, And these include the Silk Road Fund, China Latin America Production Capacity Corporation Investment Fund, China Africa Industrial Capacity Corporation Fund, and the Guoxin International Investment Corporation Limited. The Silk Road Fund in particular is a good example. It is created by President Xi Jinping to finance the Belt and Road Initiative, and has since then is not just invested in overseas strategic assets, but also financed Chinese companies' overseas acquisitions, including supporting COSCO Shipping Port in investing overseas port project. And on top of supporting China's overseas acquisition, Silk Road Fund has actually also received a second-time capital injection using renminbi back in 2017. And the purpose of using renminbi to recapitalize the Silk Road Fund was, on the one part, to strengthen its capital base. On the other part is also to advance the capacity of the Silk Road Fund, and through the Belt and Road Initiative, to broaden the renminbi's use through regional and multilateral frameworks. And this brings me to my second point, which is Chinese sovereign funds have evolved and changed their investment strategies over the years. In an area where direct investment become more difficult, they established joint ventures. For example, Silk Road Fund is the sole sponsor of a 2 billion China-Kazakhstan Production Capacity Corporation Fund, and China Investment Corporation, since 2016, has also been resorting to multilateral investment partnerships. And my third point is that Chinese policy thinkers, they have realized the strategic vulnerabilities that China's overseas investment has exposed them to. Therefore, they have learned, in particular, they have learned the lesson from Russia's war against Ukraine, as well as the West's collective sanction against Russia. Therefore, the current policy debate inside China is not necessarily with regard to how to further diversify foreign exchange reserves, because diversification cannot diversify away systematic risk for the Communist Party. In this current scenario, it means a war, possible militarized contention with regard to Taiwan. Therefore, they are likely to further promote the development of alternative financial system that is not necessarily based on the US dollar. And I will stop there. Thank you.
Thank you so much. Do you want to?
Mr. Wright, I'd like to begin with you, just so that I have a very, very clear picture of what's at stake. In your testimony, you talk about LGFVs borrowing from banks, representing 76% of debt, and then bonds issued are 1.8 trillion, and then another number was the total debt is 7.45 trillion. Can you do sort of a cascade for me of sort of what's the total debt at the local level, what's bonds, what's loans, and what do you view as inherently riskier in terms of the overall economic picture?
Sure. Basically, total local government debt is around China's GDP, somewhere between 90 to 110% of GDP, meaning somewhere between, $16, $17 trillion. The riskiest part of that is probably what is happening in short-term payables, in privately placed notes, and in the corporate bond market. So short-term payables are 6 trillion yuan, so something close to $800 billion. Total local government interest-bearing debt is 54 trillion yuan as of the end of 2022. So something close to $8 trillion or so. And the riskiest part of that interest-bearing debt is the corporate bonds, which have been shrinking in duration and around 13.5 trillion yuan. Average duration on those LGFV debt is around 2.5 years. The remaining portion so in total, all of that LGFV accrued debt is about half of the stock, which is about half of China's GDP. So the remaining portion, there's an explicitly guaranteed by Beijing local government bond issuance that is explicitly issued, that's 36 trillion yuan as of the end of 2022. So that's about 30% of GDP. And then there's an unknown portion, which is stuff issued by schools, hospitals, other government-affiliated institutions, the local level, that nobody really counts. That's probably also implicit. So roughly we're talking about 70% of GDP, or roughly $11 to $12 trillion in debt that needs to be restructured. And the problem with local government debt restructuring is not just the stock, but the flow. What happens not only when you manage the existing obligations and prevent the immediate financial market risk on a wide range of assets that are perceived to be guaranteed in China's financial markets, but how do you more sustainably finance investment in the future at a lower rate?
And as you see it now, what entities are responsible for purchasing each of these pieces of the pie? Because in my pea brain, I just see this as the debt just keeps washing through the system, and the policy banks buy, and then they push it off on a regional bank, and it just keeps money washing through the system.
Yeah, my colleagues at Rodian Group have done a lot of work on exactly where this concentration of lending is held within the Chinese financial system. So the most exposed would probably is not in the bond portfolio, but the loan portfolio. And around loans to LGFVs, around 20 to 25% of the total loans in China's banking system. So it's quite a high level of exposure. And the banks that are most exposed are most likely to be city commercial banks. Within the bond portfolio, and so the smaller city banks that kind of serve as quasi-fiscal institutions to Chinese cities and towns. Mm-hmm. Among the bond portfolio, the highest exposure is among privately placed notes, privately placed LGFV notes, because those are shorter term in duration and we don't really have great visibility about where the holdings are. What happens in China's system is that there's still a shadow banking component where banks will sell products from third-party institutions that will then try to basically add leverage or obtain higher yielding assets in order to repay investors at higher rates. And LGFV bonds were a good source of yield because everyone assumes them to be guaranteed by the government, but they're still trading at a premium to government bonds. And so that's a reasonable place to go search for what is seen to be safe yield. And that's where you have greater exposure within some of those shadow banking components, trust companies, asset management companies, in some cases brokerages, asset management arms. That's where the exposure, I think, is most concentrated at this point. That's kind of what we can say. It's still unknown exactly where all of this can be concentrated.
And in all of those instances, are the assets owned exclusively by Chinese entities, or is there access to foreign investors, access by foreign investors?
There is some foreign ownership of China's onshore corporate bonds, but it's extremely small. There is some foreign ownership of LGFV debt issued offshore, but that is also extremely small relative to there's not really a significant foreign component. Everyone likes to say that China's debt is all owed to itself, that this is a left pocket, right pocket game, that this can all just be reorganized internally. That is a politically fraught process because what you're actually talking about in that case is who is going to bear the losses, not just, and how those losses will be allocated within the system and the implications that has for future growth and the stability of that system. The problem now is that all of this borrowing is implicitly guaranteed. Someone in Beijing needs to decide that we need to expose certain borrowers to market risk and therefore risk some of these loans being cut off or not being rolled over. And someone has to decide that that's enough market risk and not too much that might spill over into broader contagion or financial crisis. That's difficult.
Do you see that, I'm sorry, I'm way over time. Do you see the article that was in Nikkei magazine a few months ago where 43 LGVFs did not roll over their paper? Did you see that as an indicator of Beijing suggesting that they're going to let some of these localities go?
I think that is I don't view it as an indication that Beijing has made that decision yet. I think it is an indication of the financial stress that is building upon local government financing vehicles. the payables, the short-term corporate acceptances, we also see other evidence of even more defaults. We can track those on a monthly basis, and they've been rising very steadily. So it shows that local government financing vehicles are not currently able to meet their obligations within their existing debt burdens, and Beijing needs to intervene to restructure that debt. I don't think, the Politburo called for a comprehensive plan to address local government debt as of their late July statement on the economy. But I don't think the fact that some of these instruments have defaulted necessarily indicates that there's a decision that's been reached about what to do about this, or to allow some cities to default or some types of bonds to default. Those are very, very difficult decisions.
Thank you. I have questions for the other witnesses if we have that time.
I will go next, and then we'll go in alphabetical order. First, thank you to all of you for preparing such great testimony and appearing before us today. I'm really struggling here a little bit. I think all of you are mirroring each other in what you're saying in terms of the economic slowdown. Is the trajectory over the next decade, the next couple decades? Is it over the next 5 years? I'm not sure what the crystal ball says, but I think, I think policymakers in Washington, rightly so, Dr. Wright, you pointed out in your testimony, people need to ingrain this as part of their thinking about what's happening to the Chinese economy. Are we getting out front as aggressively as we should about the implications to the U.S. economy if the Chinese economy continues to slow down? Not just risks to U.S. investors who are making investments in China, but also to our own sectors here at home. And what could Congress be doing right now in anticipation that this will have serious implications, not just here, but globally? So I'll start with you, but Mr. Borst, Dr. Liu, feel free to chime in.
Thank you. I think that the primary immediate spillover that we will see is not only is through disinflationary pressure or potential deflationary pressures through China's currency and through global commodity prices, which is what we've started to see some of this dynamic already, in which case some of that pressure is salutary for the U.S. economy, taking some pressure off of inflation, but that channel is fairly limited, given the low level of U.S. imports relative to the overall price level. So the concern, I think, is about China no longer being a source of growth in the region for our allies and partners as well, and the potential for greater disinflationary pressure from China's currency, if you will, feeding into competitive pressures to devalue other currencies as well. So let me just stop there.
Are other witnesses?
Sure. I'll just add a couple of remarks. I think, at least in terms of the financial markets, the slowdown in China is well understood now. It's very reflective in the performance of the major Chinese investment indices over the course of this year. So I think there's a lot of transparency and look through to a pretty broad consensus that the Chinese economy is slowing. In terms of the direct implications for the U.S., obviously, despite the slowdown in the bilateral trade relationship, China continues to be a major export market for a lot of U.S. companies, and so that will certainly impact their growth. China is also a major investment-focused market for a lot of U.S. investors, and so that will ultimately filter through to lower investment returns going forward. I think, this notion of China's slowdown is much broader than just the country itself. In many ways, it has been kind of the heart of growth in the Asian economic region. And so to the extent that China continues to slow in the way that many of us are predicting, it will have a direct economic impact on many of our allies in the region who have huge economic ties to China. So I think, the impact on growth will be significant. But I would also say that, there's a variety of different ways that this could play out. I think there's a pretty broad consensus that the growth miracle is over, that we're not going to see Chinese growth go back to 8 or 9%. But there's a range of other outcomes that can occur, and that could be a relatively soft landing, something in the 3 to 4% ratio, or if they don't handle many of these financial risks that we've covered, it could be something much lower and much more volatile than that.
Thank you.
Thank you very much for the question. I will make 2 points. The first point is with regard to the deflationary pressure right now. And it's likely that the deflationary pressure in the Chinese economy could be transitory, could be temporary, because the component driving consumer price down right now from the latest data mainly comes from significant reduction in pork prices that can potentially be temporary. And but if this became a prolonged process, then a deflationary Chinese economy would also mean the Chinese export prices could be cheaper, and that makes Chinese goods more competitive in global market. The second point that I would want to make is that a slowdown of the Chinese economy, yes, would relieve some of the commodity prices from oil to gas, but that does not necessarily mean every commodity prices would go down, because in areas where the Chinese government put a lot of emphasis in, such as chips, such as electric vehicle, such as renewable technologies and renewable energies, though for those critical mineral demand in China is still going to be very high. Therefore, even the Chinese economy slows down, it does not necessarily mean every country would be impacted to the same extent.
Thank you. I will now recognize Chairwoman Bartholomew. Chairwoman, you're on mute.
Sorry about that. Thank you very much, and thank you to our witnesses for their testimony. I guess what I'm trying to think about right now is what are the implications both within China and how China's model is being perceived elsewhere in the world as a result of these economic problems? I mean, I know watching them, the people of China going through COVID and the faith and their trust in the system that was quite shaken by the lockdowns, for example. Do you think that it's having any impact within China on people's trust or faith in the ability of the CCP to manage the economy in a way that benefits people? That's the first piece. And then the second piece is for countries around the world that have been finding the Chinese model attractive, economic growth and authoritarianism. Is there any evidence that these structural problems might be having any impact on how these countries are finding this as an attractive option? That's for any of you.
I can start on this, and happy to yield time to my panelists. I think the events of the past few years really have shaken a lot of faith in the Chinese economic model. There has historically been this implicit guarantee between the party and the people of stay out of politics, focus on the economy, everything will get better over time. The severe direct impact on many people's day-to-day lives of COVID lockdowns have shaken that for a lot of people. And so I think a lot of people are cautious about what the future means. And that's one of the reasons why we haven't seen this real strong resumption in consumption spending that a lot of people were predicting. I think a lot of people's outlook on the future has changed for the negative. And that's also quite true in the business world, where China previously had a very vibrant, dynamic private sector, really made a lot of progress throughout the 2010s. And then I think the regulatory storm that I referred to at the beginning of my testimony really shook confidence in that. You can't have big modern companies without rule of law. And when you implement policies in such a non-transparent, draconian way, that really shakes the confidences of businesses. People lose confidence to invest in the future. They don't believe that their assets will be safe. They believe, a government regulatory policy could come down at any time and really fundamentally disrupt the business model on the businesses that they have spent so many years building. So in a variety of different ways, I think it really has shaken some internal domestic confidence. And then as we've all kind of hinted at, the key role of local governments within China's economy is changing now. And that's really due to the high levels of debt that they are now burdened with. So local governments have been a key player in the real estate boom. They're a key player in stimulating the Chinese economy during downturns. And they've been a key player in many of Beijing's kind of national level policy priorities, whether it's, creating a semiconductor industry or Belt and Road projects. So now that these financial constraints are growing ever larger for local governments, they're just not going to be able to play that same role. And so one of Beijing's, key tools in its toolbox for stimulating the economy and pushing forward some of these national policy priorities is just not going to work as well as it did in the past. And then for the question about the global implications, yeah, I think that will take time to filter through. China's had such a strong economic track record for the past 2 or 3 decades. I'm not sure many countries were trying to model the Chinese economic system as a whole. It's far too distinctive and really driven kind of by the party and state dynamics that are so important in China. But the idea of a real focus on infrastructure-led development, I think we're seeing the kind of natural consequences of when that goes too far, and I think that will have big implications for a lot of different countries.
Thank you. Do any of our other witnesses have anything they want to add?
If I could add one point just on the external, the external impact of the Chinese slowdown so far. I mean, it's obviously hard to monitor public opinion in other countries, but if you look at the Pew Research surveys that have been released recently, negative impressions of China have risen to all-time highs. The issue I would urge everyone to watch is how China manages negotiations on its external loans and its external debt. At this point, because that was really where the slowdown and the inability of the Chinese domestic system to absorb financial losses from some of these loans. And our own work illustrates that there's been about $88 billion or $78 billion in loans that are either in default or under renegotiation since 2020 alone in terms of China's external lending. And the way in which China participates in that process is going to be, I think, where the rubber hits the road for their external diplomacy, because it can reveals the constraints of their own domestic political system at the same time, and their own financial stress at the same time as their external attachment to trying to provide debt relief and their engagement with the global South as well.
Dr. Wright, sorry, just quickly, do you see that there's going to be a slowdown in external lending? Because that certainly would have diplomatic consequences for the Chinese government also.
We have already seen a slowdown in external lending, basically since 2018, 2019 over that time frame, and the rising risk of defaults and renegotiations on those loans suggest that there will continue to be an ongoing slowdown in external loans.
All right. Thank you very much.
If I can just add 2 points very quickly with regards to the question about trust of faith and evidence with regards to what extent Chinese model might be appealing. So on the question about faith, I think right now what we are observing of the Chinese economy really is a run on confidence. And this run on confidence comes from both domestic and international. The reason I said that right now we are observing the crisis right now at this particular moment is because the timing worth considering. China's domestic structural problems have been existing for a long period of time. And there is a pretty good argument to be made saying that back around the time of 2009 or even 2012, a lot of these structural problems already dragged the Chinese economic growth. But at that moment, those structural problems were not necessarily crushing the Chinese economy. But right now, it seems to be that there is a crushing moment. And I think this really comes down to a run on crisis, a run on confidence. And the run on confidence comes from international and domestic. The domestic really comes from, on the one hand, consumer confidence index has been very downward trajectory. Since April last year to April this year, and April this year was the last time the Chinese government updated consumer confidence index, and they paused updating it. During this 3-month horizon, only 3 months, from January to this year to March this year, only these 3 years, those consumer confidence was above 90. Most of the time was below 90. So that basically means consumer in China are deeply not confident about the economy. And part of the reason comes from their income growth has slowed down, and then part of that is they were waiting for to what the government to make more stimulus incentives. The idea, there is this popular saying these days on the Chinese social media. In Chinese, it's said, 你不买我不买，价格减200. Translating into English, it means if you don't buy, I don't buy, the price is going to go down by 200 yuan tomorrow. So next week. So from that perspective, policy right now is very much deflationary. Therefore, Chinese consumers, household, individuals are not confident about the economy. And for that matter, we have at the individual level, they are also concerned that their economic security would be bogged down, or they might even fall victim to a broader geoeconomic confidence. And with regard to international, it really comes down to President Xi Jinping's policy swings and policy uncertainties generated lots of risk and uncertainty. So I'll just stop there with the interest of time. Thank you.
Thank you. Commissioner
Thank you very much.
Wow. So many questions in so little time. What a great panel. Thank you all very, very much. I started my own business in the early 80s, and within just a couple of years, we had all the savings and loans in the country go broke, largely for reasons that you're describing occurring in China right now, which is surprising to me a little, although I've been reading about it. So I have a sense of what's going to happen, because we had all the developers in the United States effectively borrowing against future promises, and then the market changed a little bit, and we passed a law that changed, and everybody failed. All of you have talked a bit about the debt ratio to the GDP, and I understand that. In the private sector in America, it's common to have a large loan with a bank where quarterly you have to talk about your debt versus your overall income. And when it hits a certain number, in my case, say in the 90s, we got up to around 2/3 of our gross, was our GDP. We suddenly had to come up with money to lower that ratio. So it's something that is common in business and government, and obviously not in China. I'm going to ask a question first of Mr. Borst, and then I guess in order, if we have time, Dr. Wright and Dr. Liu. Mr. Borst, you talk a bit about the debt to GDP ratio, and that strikes a chord with me, because I know that on the one hand, the local governments are running over 100%, but as a country, they're one of the best in the world, right? Around high 60s. And America has continually increased for a very, very long time. In fact, we have the 12th worst ratio in the world, behind countries like Venezuela, Japan, Greece, Lebanon. Singapore and Bahrain all have worse ratios than us. Everybody else's is better. We're at like 128, I think, if I just looked. So my question for you, Mr. Borst, is if our ratio to GDP as a country is one of the worst in the world, why is that not a major disaster compared with China and what they're facing? It would seem like each of you has said that systemically the central government could bail them out, but probably won't. And I'm inclined to agree because of politics. But how do the two compare when ours is so high and theirs is so low? Are we at risk, really at risk, if they have a further slowdown?
Yeah, thank you for the great question. You know, the U.S. and China total debt to GDP ratio, if you're looking at both households, business, and government debt, is about the same. I think China has surpassed the U.S. in the last year or two, but both about 300%. But the real issue, I think, is the structure of that debt. There's an issue at the first level of, you know, we think of economies as they advance have this process called financial deepening, and it's much more sustainable and normal for an advanced economy to have higher levels of debt. Well, China has hit advanced economy levels of debt at a much lower level of GDP per capita. So China essentially has rich country levels of debt at middle income levels of GDP development. So that's one problem. But the real issue is, again, the way that the debt is structured. And so you mentioned on the government side, it's true that the central government of China has a very low debt to GDP ratio. It's about 25%, which is extraordinarily low compared to most other major economies. You know, the US is about 100%, Japan is, 250%. So from that direct perspective, you could say, well, the Chinese government has all this fiscal capacity. But the problem is, as we discussed earlier, is the local government debt situation. And so a lot of debt that in other countries would probably be considered central government debt has been really foisted upon the local governments. And there's this core imbalance in China's fiscal system that I talk about in my testimony that has been the source of so many problems in the economy. And that is that Chinese local governments are responsible for about 80% of total spending, but they only get about 50% of the revenues. And so the central government takes more than its share of revenues. It does distribute that back to the provinces a little bit through transfers, but local governments in China are constantly facing a structural fiscal deficit. And so they have invented all sorts of ways to get around that. Part of that is making money through land sales, although that line of business has dried up due to the real estate correction. And the other has been these off-balance sheet vehicles that we've talked about, the LGFVs. And so local governments have used off-balance sheet vehicles to borrow heavily, to spend on their behalf. But the problem is that these off-balance sheet vehicles really don't have any revenues of their own. They're completely dependent on new borrowing or from financial injections from the local governments. And so this core issue of local governments having all these spending responsibilities, but not enough revenues to do it, hasn't been resolved. And until it's resolved, I'm very pessimistic about some of these financial problems. There are possibilities where they could take steps that I think would help change this. I talk about it in my testimony. The central government could take on more of these debts or could give more revenue to local governments, or they could finally sell some state assets to cover these debts. The problem is all those different policy choices are very difficult from an ideological perspective in China today. And so the debt levels are high, but the real problem is the way the debt is structured. And I think they're ideologically constrained from taking some of the steps that would be necessary to resolve that problem.
I think we're out of time, so I'm going to defer to the chair.
Thank you. Commissioner Friedberg.
Thank you very much, and thanks to all our witnesses. It seems that all of you, to the extent that you've touched on this point, seem to be agreed that China is headed for perhaps a sustained period of slower growth, and that the reason for that is something that's deep in the structure of the system as it currently exists. It's not just the result of short-term policy. So my questions, and I guess for all three, and one, is there reason to believe that the CCP is perhaps okay with this? They might prefer that they were growing more rapidly, but they seem to be talking about making the point that growth is not the only objective and that control and security and so on are critical. So first, is there reason to think that they're okay with it? And second, if not, what exactly could they do about it? And there's one answer to that that's implicit, I think, in some of the testimony, and that is that they could go back to the direction in which people thought they were moving 10 or 15 years ago towards losing CCP control. If that's not likely in the short term, what are the alternatives for that? Could they push exports? Could they rely more on technological innovation? What could they do to get out of this corner? Mr. Borst, maybe we could start with you.
Sure, I'll just speak briefly because I want to leave time for the other panelists to chime in. But I think we are seeing a real struggle. I mean, we've seen over the past month or so a suite of new private sector reforms come out really aimed at improving the operating environment for the private sector. I think at the end of the day, the Chinese economy knows they can't grow entirely through SOEs, that they need the private sector for employment, for revenue, and for innovation. But it's been difficult. I would note that even these private sector new reform initiatives still talk about increasing the role of party committees at private companies and having private companies support national policy objectives, which, in my opinion, are not great drivers of growth. So I think there's a struggle going on right now to figure out what the new driver of growth is. And from my conversations with Chinese economists, I think they're most likely to lean on the old playbook, which is just build more infrastructure, even if the country doesn't need it.
Okay, thank you. Dr. Wright?
Certainly. And I mean, I think that the way I would answer that question is that there's an understanding in China and Beijing that there are real constraints in the previous growth rate, but the forward-looking expectations are still very much contingent upon political objectives to double Chinese GDP by 2035, for example. And that requires rates of growth that are probably higher than what can be sustainably financed with China's system or under these new structural constraints. So it's more that the political discussion around, if you tell Chinese leaders that growth needs to be lower in the future, everyone can accept that. If you say that growth needs to be lower in the future, and that probably means that people are going to question whether we're inevitably rising in great power status and that we're going to, and that the great rejuvenation of the Chinese nation will be complete, then that's unacceptable. And so then you get into these constraints about what can actually be done in terms of structural reform. And Dr. Friedberg, just in response to the question, I mean, I think you're exactly right. You need some sort of reinvigoration of the reform agenda that was put in place with the 60 decisions of the third plenum in 2013. And it's been obvious that there's been, initial attempts along those lines and then rapid backtracking when the market implications, the economic implications, those reforms become apparent. So the problem now is that after 10 years of backtracking and more statist direction of the economy, how do you actually send that sort of, big bang signal that things are actually different? How do you credibly do it? Because there really is an inverse relationship between the concentration of political power and the credibility of some of these counter-cyclical and reform signals.
Okay, thank you. Dr. Liu?
Thank you for the question. And I would emphasize two aspects. The first part in terms of what if the CCP is not okay with lower growth, what are they going to do? The two aspects that the CCP would emphasize, and they have given clear policy signals to do, is to emphasize incentivize consumer spending and to focus on efficient investment. On the point with regard to incentivize consumer spending, since last December in particular, they put out for the very first time a strategic plan to expand domestic demand. And on the domestic demand expansion aspect, for the very first time, they prioritized incentivize consumer spending rather than focusing on government-led investment. And since the beginning of this year, there have been several policy guidelines focusing on ease consumer credit environment and all that. So from that perspective, incentivize Chinese household, in particular, private consumption is one important aspect. And they do have the reason to do that because right now, private consumption as a percentage of Chinese GDP is about 40%, whereas the global average is about 60%. So from that perspective, the Chinese economy has significantly been under-consuming. And then the second point with regard to efficient investment, the primary aspect obviously is related to where the strategic sectors such as electric vehicle, quantum computing, artificial intelligence and all that, but there is also a very important or practical aspect that Xi Jinping is prioritizing, which is rural revitalization and focusing on not just land, farmland, but also food security, and the idea is to strengthen the rural base of the Chinese economy because major cities have basically been built out, whereas the further investment potential area would be the rural area.
Thank you very much.
Commissioner Goodwin.
Thank you, Madam Chair, and my appreciation to the panel. Dr. Wright and Mr. Borsch, I want to return to this conversation about China's efforts to address local government debt problems. And Chair Cleveland was exploring this early on in her question, but earlier this month, I know the Politburo announced what they refer to as a basket of measures to help address this challenge. And some news reports earlier this month suggested among those measures will be a refinancing bond program authorizing these local governments and municipalities to issue up to $140 billion in bonds to refinance outstanding LGVF debt with better interest rates. So I want your thoughts on the wisdom of that, essentially going into debt to repay outstanding debt, but also if you have any insight into the structure of those refinancing issues. Have they identified a dedicated revenue stream to pay the debt service on those bonds, and to what extent will the central government be involved in backing those issuances?
I'll start if that's all right. The problems in local government debt refinancing, it's really a fourfold problem that China has to grapple with all at once. First, you have the stock of existing debt. Second, you have the flow of how you're going to finance new investment in the future. Third, you have the entire basis of the central-local fiscal relationship and how you can more sustainably put local government finances, on a new plane. And fourth, you have a broader problem of how to raise fiscal revenues in this system altogether, because most of the tax system in China is heavily dependent upon investment-led growth and local government investment-led growth and the property sector overall. So this is a huge structural problem of which the measure you were discussing, the news announcement, is a very tiny first step in terms of alleviating some of the short-term financial pressure when you're talking about a trillion yuan or 1.5 trillion yuan. Something that would meaningfully address the stock of local government investment probably needs to be in the range of 30 to 50 trillion yuan. And ultimately, the only source of financing for this type of bond issuance to refinance older high-interest debt with lower interest government bonds is probably going to be the central bank balance sheet. And that could be done quickly. It could be done slowly. Beijing has a lot of choices in this regard. None of them are very good. Do you want to start small and then sort of expand this program over time so as not to frighten markets? Do you want to, start with individual provinces or cities or individual debt instruments? But when you do that, you hypothetically expose those others that are not directly guaranteed to market risk. Not an easy choice. Or do you want to try to break the implicit guarantees in local governments by allowing a few of these to default and then coming in with sort of a rescue package? These are uncharted waters, is all I would say. And the kind of measures you're hearing so far are very tiny incremental steps along those lines. I think we will see a plan emerge in the next 6 to 12 months, but I think it's far more likely to be a reactive incremental plan to address this rather than something more comprehensive and proactive.
I would just add on that, I think all of us are a little bit having deja vu because we've seen this happen before. So if you go back a decade, 2011, 2013, they're trying to get a handle on just the sheer amount of local government debt, setting out audit and inspection teams. 2023, that's happening yet again. The central government still doesn't know exactly how much local government debt is out there. And then one of the main changes being talked about is, local governments issuing more bonds, taking some of that off-balance sheet debt, making it explicit. That happened in 2015. And, in general, it's good to take, high interest rate, very short-term debt, transform it into something that's lower interest rate, more sustainable over the long run. But it doesn't solve the fundamental issue of, as long as these local governments continue to have this structural financial deficit, they're going to keep borrowing through these channels. So a little bit of blast from the past. We're seeing the old playbook, maybe even not as aggressively as it was pursued in 2015. The other thing that we're seeing is that the losses from some of these debts are really being hidden. And the way that's occurring is that, for example, with many of the off-balance sheet local government bank loans banks are being told to extend that, extend the loan tenor 5, 10 years, zero interest payments for 5 years, that sort of thing. That has the same effect of recognizing a debt. You're just doing it in a different way. And so I believe a lot of these losses will ultimately show up on the balance sheets of banks, the balance sheets of insurance companies and other investors in these bonds and other investors.
Thank you.
Commissioner Hellberg.
Thank you, and thank you to our witnesses for their testimony today. Having seemingly run out of dissidents and business leaders to disappear, it looks like the Chinese government has now graduated to disappearing its data. The Economist and the Guardian have described China's real estate market as a giant Ponzi scheme. The Washington Post also reported that a study of satellite imagery suggests that China may be inflating its GDP by up to 30% on any given year. If real estate activity makes up the lion's share of China's GDP growth, if China lies about its GDP numbers, if the Chinese government is juggling debt by using its right pocket to fill up its left pocket, if China is now hiding all of its underlying GDP data and investors aren't able to do any meaningful due diligence, can you explain to me how any investors could be confident that China's economy isn't a giant Ponzi scheme? And would any of you hypothetically invest your own family's retirement accounts in China?
Maybe I can start with that one. I think we're very concerned about the trend and direction with Chinese data transparency. I've been following Chinese data for a long time, and I think, earlier, a decade or so ago, it was actually getting better in terms of frequency and transparency for a lot of data releases. But particularly over the past 2 or 3 years, I think we've seen more and more data sets kind of not reflect what we're seeing in reality. And then also data sets that we've relied on no longer being published or being published very infrequently. So that's a major concern. I think, that's macro data. For company data, which is what I primarily deal with, we are always skeptical of every company's data. I think that's key to being an investor, is to approach a company's data with a skeptical mind. And so we try to rely on many different methods, looking at audited financial results, combing through financial models, talking to outside analysts, really making sure that a company's data can be triangulated in a variety of different fashions. But I think investors as a whole, if they can't get comfortable with either the macro data or the company level data coming out of China, will reduce their exposure to that market. And I think that's
how do you triangulate data about a company in China?
Yeah, so there's a variety of different methods, that's talking to the company, looking at outside sources of data that might be able to be matched against the data the company itself is putting out, comparing that company not only to its domestic competitors, but what we see in international companies that are in a similar industry or a similar business model, and really trying to look at it from a variety of different ways and just see if it passes the smell test.
Next witness, please.
And just in response to that, I think one of the things that we try to do is to follow the money in China's financial system rather than the official data. So there's actually fairly reasonable data on China's credit expansion, the state of the banking system, and one of the reasons that we've done this for so long is precisely because that is a very robust sort of area of data that's available, while the headline economic data is less reliable, particularly in terms of GDP. It's just not realistic to assume that China's GDP was more stable than any other countries that we could find over the 2014 to 2019 period, where GDP growth barely moved at all, despite the fact that policy changes, both monetary and fiscal, adjusted quite a lot over that time frame that were more indicative of a regular economic cycle. Similarly, it's not really realistic to say that China's economy grew at all in 2022. It's far more likely that the economy contracted in 2022, given the impact of lockdowns and other restrictions on activity. Headline Chinese consumption growth was negative. Investment from the property sector had certainly contracted.
How do you follow the
money
in a system that basically treats as espionage and criminalizes doing basic due diligence on a company? And would any of you invest your own family's retirements in China at this point in 2023?
I think the point on that that I would argue is that China faces this long-term problem in restoring investor confidence. The outflows from China's system are inevitable. The inflows are not. The inflows are highly contingent. The outflows are inevitable because China has this the world's largest money supply in dollar terms. The inflows depend upon all of those individual decisions that investors make. And investors have different priorities, and an absence of information can sometimes be a benefit to certain investors if they think that's an opportunity that they have information that others don't. And that is a different type of market environment. It's not the one where China has been trying to develop over the last 2 decades, but this is sort of where we are.
I would just add on that too. I can only speak to my personal experience, but I've done 2 trips to the country this year. I've met with more than 24 Chinese companies, found them very willing to talk to me, open and transparent about the challenges they were facing. And to answer your question, Commissioner, I do have my own personal funds invested in some Chinese investments.
And so, and you talk to Chinese business executives in China, and you don't think that Chinese business executives have a long history of misrepresenting their books and misrepresenting their information to American visitors? You don't find that there is a long 20-year track record of misrepresentations in their characterizations of their economy? You trust that we should invest billions of dollars of pension fund money in the Chinese market at this point?
Yeah, we invest in a lot of difficult markets around the world, and I would say we always approach every single investment with a skeptical eye, and we never invest unless we can get beyond some of those thresholds.
And you think we should be, from a U.S. government standpoint, the U.S. government should allow American pension funds to deploy billions of dollars of funds based on a smell test and verbal conversations with business executives in China, not based off of objective due diligence that every American company has to go through here in the United States that's based on disclosure, accounting rules, and so forth?
Yeah, I think the most important things from a U.S. Investor perspective, I think, is transparency and disclosure. I think.
Do we have transparency in China?
I think
just outlaw that.
So I'm talking about the funds themselves. So I think it's very important for funds to be very clear about what their investment objective is, what exposure they will have, and most importantly, what are the risks that investors in a particular fund will face. And so that is a key component of investor education. And I think there's always a lot more we can do to make sure that American investors, when they invest in China or any other overseas market, really understand the risks associated with their investment.
Well, I don't want to take up more time, but my view based on this exchange is that it's high time to suspend the deployment of American pension funds in China, and typically American pension funds are not in the gambling business, they're in the wealth preservation business. Thank you.
And we will have a round 2 if time allots. Commissioner Price.
Hello, and thank you all for your testimony today. I found it very, very compelling. I want to pivot to some of your recommendations that you put in your written testimony. Some of them were very interesting, and I'd like to flesh them out a little bit more. So I have questions for each of you. I'll ask them all at top, and if we run out of time, we'll either go over or we'll come back to it afterwards, so thank you. So Dr. Wright, in your second and third recommendations, you talk about taking more active steps for financial support to emerging economies struggling to renegotiate debt. Can you talk about that a little bit more? And also trade policy that facilitates de-risking. You probably could do a whole another 20 minutes on that, but give me your top priorities for de-risking. Mr. Borst, you talk about giving investors clear rules. Can you just expand on that a little bit briefly? And Dr. Liu, you talk about a shared entity list, make recommendation around that. I'd like you to flesh that out a little bit more as well. So, Dr. Wright.
Certainly, thank you for the question. So I think that the point is that unless there is an alternative to Chinese lending and an additional source of finance, that it's going to put a lot of pressure on emerging economies. Beijing is still going to stay at the center of that diplomacy in terms of how to renegotiate the external loans that countries are struggling with at this point. What Congress can do, what other lenders can, in combination with the private sector, is provide a realistic alternative for alternative sources of financing, and that can help, at least at the very, to be an effective bargaining chip and force Beijing sort of back to the table in negotiations, even if it doesn't, even if it's not necessarily, productive in the short term. The point being that all of these countries are going to continue to be dependent upon Beijing actually acting, renegotiating, and extending debt unless we can offer something else as a source of financing. And so we need to actively consider what that would be and what that might do for a more positive and externally oriented aspect of U.S. financial diplomacy to the rest of the world and to the global south, where Beijing has been extending influence in recent years. So that's the argument within that recommendation. And similarly, when we're talking about de-risking from China's economy, we're talking about diversifying supply chains. We need to have a trade policy that is lowering trade barriers and facilitating the kind of public-private investment that is consistent with those markets where we're developing alternative manufacturing capacity, being able to access U.S. and allied markets more effectively. And that's the argument.
Thank you. Mr. Borst?
Sure. So just to add a little bit about the clear rules. So I think, U.S. policymakers have rightfully identified areas where there are key national security risks to providing Chinese companies with capital. And I think the vast majority of investors understand that, support it. But I think the key is setting out a framework that is transparent, predictable, gives U.S. investors plenty of time to understand the new rules, is very clear about how investors can comply with those new rules. And I think really importantly is having a review mechanism in some of these restrictions as they go into effect over the course of years. It's once a restriction goes into place, it can prove to be very difficult to unwind it, even if the situation has changed, if it's creating unintended consequences. So I would really just advocate as policymakers rightfully target specific areas of the Chinese economy to prohibit investment, that they're also thinking about, what look-backs are we doing 1, 2, 3, 4 years out to make sure that these rules are really working the way we thought they would, that they're not having unintended consequences, and that is a clear framework for U.S. investors to comply with this and not inadvertently trip over some of these restrictions.
Thank you. Dr. Liu?
Thank you, Commissioner Price, for the question. The shared entity list that I proposed as a recommendation is really with regards to, in the broader context of a coordinated FDI screening, both inbound and outbound and offbound, both in the United States and with our European allies, because the European Union has implemented their own version of FDI screening, but they are not necessarily to the same expertise or the same extent as the United States. The whole idea is not to implement protectionist policies, but really to strengthen U.S. leadership in shaping the FDI investment environment in the world. And I think there are some ground rules should be adopted with regard to both a shared entity list in terms of companies or foreign investors that are not welcomed, and an exempted foreign entity list that are sort of, the so-called white list. These are okay. And the whole idea is to convey to our strategic rivals, such as China or other competitors, the idea is not to constrain China's growth, but really is to not put a boundary with regards to what are off the limit. Because right now, I think in the U.S.-China relationship, the point of contention is that America's idea or America's intention of not focusing on containing China, this message is not delivered to the Communist Party and Chinese leaders. Therefore, by having a white list and a restricted list perhaps would be a good way to communicate America's intention.
Thank you. Very helpful.
Commissioner Schreiber.
Thank you. This has been a fascinating discussion, and that was actually an excellent segue to what I wanted to ask about, but thank you to all our witnesses. So focusing on what the U.S. policy toolkit is and what we might do in response to the trajectory of the economy. I mean, mostly we've talked about insulating ourselves from spillover and protecting ourselves. We've talked a little bit about how we can stabilize. But I want to ask a different question. This is our strategic adversary, our rival. What if we wanted to pile on? What if we wanted to make these problems worse? What if we wanted to put Xi Jinping under tremendous pressure? What if we wanted to, divert their attention in ways that they never bother us on the outside again by having to focus, very intently on the economic problems and youth unemployment and the like. So even if you don't agree with it, and even if it's marginal, what are things we could do to kick them while they're down, if you will, put pressure on them given the experiences that they're having right now, the trajectory they're on?
I would argue against that sort of approach simply because Beijing's going to blame the United States for doing that anyway, as that occurs. Sorry, go ahead.
No, I said even if you don't agree with it, marginally, yeah.
Understood. I mean, I think that the challenges that course of action confronts are also about alignment with our allies and partners. And so any direct action we would take would be far more difficult to maintain the sort of agreement and transatlantic alignment toward policies and preventing backfilling among sort of controls on supply chains and changes in manufacturing policy that we would expect. I mean, I think that that's sort of the concern we would. That's sort of the concern we would have. I mean, in terms of hypotheticals about what could, hurt the Chinese economy in greater sense, it's very difficult for me to come up with anything externally that would do more than what has already taken place in China over the last 5 to 10 years. In other words, if you were going to think about how to sort of undermine the vitality of a robust private sector in China, you would do roughly what Beijing has done in trying to single out some of these firms for political targets in the last couple of years. So it's a hard question to answer just because, I mean, is anything that the United States thinks about likely to have anywhere close to the same effect as a signal from China's government itself in that context?
Yeah, just to add on that, I totally agree with that most of the problems China's facing now are self-created. So in that sense, they're their own worst enemy at this point. But for the hypothetical, if we want to continue to increase economic pressure on China, I think further decoupling will increase pressure on China. There's been more extreme measures that have been discussed in the policy world, and those could be put forward. Those will have a direct cost on U.S. companies and U.S. investors, but maybe if you weigh the costs, it'll be more heavily on the Chinese side. But just to echo some of the comments, I think that approach in the short run will increase pressure on China, but I think over the long run, it will actually be damaging to U.S. interests, because I continue to believe that a angry and isolated China is a greater danger to U.S. interests than one that is interconnected. And we've seen, the approach of sanction and isolate applied to many different countries, even smaller, more isolated countries that really hasn't paid real dividends. Chinese economy is too big, too interconnected, too dynamic to be isolated in that sense. And I think if we pull away the ladder and tell, policymakers in Beijing and Chinese businesses that there's no room for them in the international economy, I think we're going to see some behavior and reactions in China that are much worse than what we're dealing with right now.
Thank you for the question, Commissioner. And I would also wanted to echo my panelist. Key argument with regard to perhaps there is more harm, the harm to the United States in terms of further pressurizing China, especially right now when the economic growth slows down, is probably it hurts transatlantic partnership, as well as our trying to build strengthening our alliance with Japan and Korea. And on top of a lot of these supply chain pressure spillover effect, there is perhaps another underappreciated challenge that for the United States, if the Chinese economy continue to worsen, and that is immigration problem. Since the COVID pandemic, Chinese illegal immigrant came across the Mexican border actually have more than doubled. So from that perspective, I think the further pressurizing China probably would create more harm to the United States, both economic-wise and for us to dealing with our immigration problem. And in a hypothetical world, in terms of pressurizing China, perhaps trade is a very important aspect because the Chinese economy is still very much export-driven. But again, trade would be hurting American companies' interest as well.
Thank you. Just for the record, I think if we were on our back heels, I don't think the discussion in Zhongdonghai would be how can we help the United States. And I think we've got problems with fentanyl right now. We got all kinds of problems, and I see them pouring fuel on the fire at every opportunity they get. But thanks for the thoughtful answers.
Commissioner Wessel.
Thank you all to the witnesses, and Ms. Liu, I was hoping to be there today to have you sign the book, your recent book, appreciated it, and followed your work at CFR and elsewhere, so thank you. I'd like to go up for altitude, maybe literally as well. I think it was The Economist that had a article earlier this summer. I think the headline on the or the cover was "Peak China," and what I'm hearing from each of the witnesses today is, in some ways, that China has peaked, and I think that is underappreciates what China is doing. That it is de-risking. Whether it's through Belt and Road, whether it's through other industrial policies, whether it's through outbound investment approaches with Indonesia and nickel supply chains, or many other things. And I think what all of this, what I've heard today, is potentially following some of the flaws in our earlier analysis of China. First, that reform would come from economic engagement. As you said, Mr. Boris, we've been through this somewhat before in the 2010s or so, and we're following the debt issues. We continue to evaluate China's approaches through a Western lens rather than through the CCP's lens. And I think that leads to fundamental flaws in terms of how policymakers are being told to respond to China. And what I hear is de-escalation. What I hear is de-risking. What I hear is don't push too hard, too fast. Rather than what are Western interests, first the U.S., how should we pursue them and worry a little less about how the CCP is going to, how the CCP leadership is going to respond? So, and first, the question of has China peaked? Is that relevant? Is there a different trajectory they're on, and we don't appreciate it? And is the current reset in U.S. policy with a limited outbound investment executive order, slowdown of congressional action on China, a sign that potentially we're reaching a new stasis? Mr. Boris, you want to start?
Sure. Yeah, it's a great question. I saw The Economist cover too. It was very provocative. I guess I don't quite know what they mean by peak. I and others have argued that the growth miracle in China is over. We're not going back to 8 or 9 or 10% growth. And so from that perspective, we have entered a new era. But China is still going to be around. I don't think the Chinese economy is collapsing. I think there's many scenarios where the Chinese economy could grow slower, but still healthily at a 3, 4, 5% level for the next decade or more. So China will continue to be an important global economy. It will continue to be a major source of global economic growth. I think the IMF is projecting that even with the slowdown in growth, China is still going to be about a third of total global growth. And the U.S. will continue to have significant business interests in China. And I think now, as I say in my written testimony, is a really opportune moment where tables have turned a little bit. The U.S. economy is doing quite well. Chinese economy is kind of on their back foot. These have been the periods in Chinese history when they're actually most open to economic reform. China doesn't reform just to reform. It doesn't do it out of the good nature of its heart. It does it because it knows it needs to continue economic growth and how important economic growth is for the country. So I think this is a good moment. If we understand that China's not going anywhere, they're not going to disappear. I don't think the Soviet Union, outcome is likely. How do we continue to live with the Chinese, and how do we proactively advocate for U.S. interests as it comes to the U.S.-China economic relationship? That's what I think I would hope that policymakers would really be focused on right now.
Mr. Wright?
Yeah, I would agree with much of what Nick just said as well. And I think this is an opportunity. It's not that the peak in China, so to speak, is it probably true in a broader economic growth or economic trajectory sense, but that still doesn't mean that the challenges that we're facing from China in many senses have peaked, whether we think, and instead, I would argue that this is an opportunity to refocus U.S. efforts, not on what the interaction between China's growth and inevitable rise, quote unquote, will do to those challenges, but instead focus on these individually, focus on them far more narrowly. When we're dealing with military and security challenges in Taiwan and the South China Sea, when we're dealing with spread of advanced technologies and competition in advanced industries, and in China's politicized influence over some of the next generation industries we're dealing with, and that's the only thing I'd add.
Thank you.
And thank you, Mr. Vissel, for your question. With regard to the question about peak China, I would say I agree with my panelists, Nick and Logan. And in particular, I would wanted to emphasize that actually China is still very much a leader in renewable technologies, in the transition towards a cleaner energy future. And China is still very much dominating the supply chains of critical minerals that are necessary for the world to transition to a renewable future. So from that perspective, I think, yes, if we measure the Chinese GDP growth or measure export as a percentage of GDP, China's economic growth model or the old playbook perhaps has reached running out of pages, perhaps. But depending upon how the government reform goes forward, and in particular the politics of that, there is a chance that China can sustain, but given the current political environment, is not clear. And with regard to de-escalating or the tension, I very much appreciate that question. And I think perhaps both countries or policymakers in both countries can borrow from a page book by Otto von Bismarck. I remember he once said, I forgot which year, but he once said, diplomacy is about the art of building ladders to let people climb down. And in Chinese, I think it basically means to 给台阶下, let somebody gracefully climb down. And I think perhaps right now, American leaders should lead the moral high ground to give President Xi Jinping and the Chinese leaders an opportunity to gracefully climb down.
Thank you.
Thank you.
I'd like to recognize Vice Chairman Wang.
Well, since Bismarck was invoked, he also said war is diplomacy or the continuation of policy by other means. I don't know how that fits with the latter, but anyway. Dr. Wright, I want to focus in on some of your recommendations. you recommend what you term alternative channels of financial support for developing economies that are struggling to renegotiate debt with China. What do you mean by that specifically, if it doesn't mean the kind of current multilateral lending institution or multilateral development bank lending that we do with our allies?
That would likely be a component of it, I would say, Commissioner, but you would probably need some additional policy support for private sector to invigorate private sector support for that as well. The point is, you need an alternative. If Beijing is not going to provide meaningful debt relief, and the negotiations are sort of starting to bog down in that respect, and countries are struggling with significant financial stress, then they are going to need some sort of additional marginal source of new financing. And ultimately, this means the rest of, we will need to provide some sort of alternative for that, which has the added benefit of, if you will, removing Beijing from the center of that aspect of economic diplomacy, with some of their primary allies in those countries aligned with them because of Belt and Road related lending.
So would that in effect be the U.S. and our allies helping to refinance debt to China? I mean, effectively?
The whole argument would be that if China is not going to provide meaningful relief, that you need to provide countries with an alternative of saying you can walk away from your debts to China, and we will still provide, and that will not impact your broader credit status and your creditworthiness in global markets. That's kind of what we need to offer, renegotiating with everyone else.
Okay. And the strategic impetus behind that is that for us to blunt Chinese influence? Is that humanitarian? Is that to maintain global financial stability, or is it all three?
It can definitely be all three. I mean, I think you can argue this is very self-interested from the United States perspective, that it fulfills this strategic objective because many emerging economies are going to be struggling to maintain basic services. There's various measures of just how distressed given the rise in U.S. dollar financing costs, the rise in debt in recent years. There's going to be significant pressure in emerging economies unless someone provides that form of debt relief. So you can argue it's explicitly self-interested in that respect, that we maintain global financial stability through those channels. But it also has the added benefit of expanding the U.S. channels of influence with countries with whom China has engaged most directly in recent years.
Alex, can I clarify something, please?
Sure.
In that context, are you suggesting that China's, the underlying asset or the project, they're severed from? So international donors step in to try to offer the relief that some country needs. What's the ongoing relationship with China, and how do you avoid free riding?
Yeah, I'm not sure exactly how that will work out. I'm not sure exactly how that will work out. I mean, that is going to be a problem. The point is, without an alternative, these countries are still going to be within Beijing's orbit and engaged in this very slow process where Beijing's not providing this. But in terms of the actual mechanics of how debt renegotiation will work, I can imagine some scenarios in which they would be walking away from those projects. I can imagine some scenarios in which you would find alternative financing channels for them.
Okay, I think I'll send some follow-up written questions on that, because I think it's a nuanced and detailed topic. But I also want to talk a little bit about your phrase in one of your other recommendations about next generation trade and investment policies to aid in de-risking and supply chain diversification. Now, you touched on this in another question and answer session with Commissioner Price, but I just want to ask, at the risk of being somewhat sensitive here, I mean, this term next generation I know is stylish, but are we really just talking about old generation kind of investment treaties and trade agreements, whether it's sectoral or broadly based?
Absolutely. I'm not trying to imply that there's anything really innovative or different about this. I think what we need to do is, if we are ensuring, I mean, in order to sort of reinvigorate the trade policy agenda to try to reduce barriers over time, if you are going to be trying to provide or offer alternative sources of manufacturing supply chains from locations in China, you're going to need to be reducing trade barriers so that countries can be encouraging investment at lower cost, and the byproducts of that investment can also be traded more regularly. So yeah, it is a basic call for reinvigorating U.S. trade policy in Asia in particular, and more broadly. But that is the argument, is that if you're thinking about de-risking or decoupling kind of risks, you need to be thinking about the next step of this as well. That's what I was trying to say in the recommendation.
Our second panel will examine evolving trade and supply chain challenges in the U.S.-China relationship. We'll start with Dr. Christopher Gopal, who is a former executive, a global supply chain consultant, and the author of the recent book, Breakthrough Supply Chains: How Companies and Nations Can Thrive in an Uncertain World. He will provide an overview of the evolving supply chain landscape. Then we'll hear from Dr. Ilaria Mazzocco, a senior fellow with the trustee chair in Chinese Business and Economics and the Center for Strategic and International Studies. She will address the rapid rise of China's EV exports and the role of China's green industrial policies in its trade and supply chains. We very much appreciate both of your testimony and would like to remind to keep your remarks to 7 minutes so that there is ample time for questions. Dr. Gopal, there you are virtually. Why don't we begin with you?
Thank you, ma'am. And first, members of the Commission, I'd like to thank you for the opportunity. Can you hear me?
Yes.
Oh, good. I'd like to...
No, we can't. Count backwards. Okay. Something's happening with our sound, with our witness. Do you suppose that we could correct that? Because I know I can't. Why don't we move to Ms. Mazzocco? Could you pick up while we're trying to sort out whatever pixie dust needs to fix that? Thank you.
Thank you, members of the Commission and staff members of the Commission, for the opportunity to be here today. I've been asked to discuss the electric vehicle sector in China and implications for the United States. Let me start by saying that, like with other clean energy technologies, such as solar panels, China's growing importance in the EV supply chain hinges on its cost advantage. Vehicles made in China are affordable and of increasing quality.
I can hear you, and I'm hearing several people.
Mr. Gopal, we've asked your colleague to go ahead and speak because we couldn't hear you. So we're trying to correct your technical difficulties. Can you hear her speak?
I can hear you. I can hear Ilaria, yes.
All right. Well, if you'll wait until she's finished testifying, then we'll turn to your testimony.
Absolutely.
Thank you. Shoot.
Great. So vehicles made in China are affordable and of increasing quality, making them attractive to consumers worldwide. The cost of these vehicles could also undermine the supply chain and diversification efforts underway in the United States, although they could also help advance the electric vehicle adoption worldwide. As a consequence, policies should take into consideration the trade-offs as well as cost and competitiveness. I will now discuss briefly the state of the industry in China and how competition and large manufacturing capacity there, combined with increasing international demand, are driving a surge in exports, then discuss what the patterns in exports looks like, and finally, how growing exports are setting the scene for an expansion in international manufacturing on the part of Chinese companies. I will now offer some recommendations. The EV industry is considered today one of the most successful instances of industrial policy in China in recent years. Indeed, as a result of converging industrial policy, government interventions, including subsidies, market and technological trends, most EVs today are bought and made in China. As is typical of industrial policy in China, after a wave of overinvestment, we may be headed towards overcapacity, and intense competition is certainly underway. A very large number of companies entered the market attracted by subsidies, but they are now navigating the most competitive EV market in the world, driving down prices. Consolidation of the industry may be complicated by the web of relationships between companies and local governments. something that has characterized the traditional automotive sector in China as well. Local governments have provided various types of support, including tax breaks and preferential procurement contracts, but they're also quite literally invested in the success of companies. Importantly, several investment funds owned by local governments are investors in EV companies. This is an example of below-market equity, but access to below-market credit is also widespread and an industrial policy tool in China that EV companies have benefited from. Some non-Chinese companies have also benefited from government support at times, especially from local governments. This competition is driving down costs and putting pressure on companies to find new markets. As a result, EV exports from China are growing fast. They doubled in dollar terms from 2021 to 2022, and based on data from 2023, it looks like they're probably on track to double again. Europe and Asia are the main destinations of these exports. Foreign companies are certainly part of this trend. In the first half of 2023, Tesla accounted for almost 40% of exports from China, and joint ventures between Chinese and European companies accounted for another 9.5%. So that adds up to almost half of the exports. This points to two concurrent trends. China is becoming a manufacturing export hub for multinational companies, and Chinese-owned firms are becoming increasingly competitive and exporting more to new markets. As these Chinese firms expand their market presence outside of China, they have an increased incentive to localize production. By making vehicles and batteries locally, companies can avoid tariffs and high transportation costs, benefit from host government incentives, and mitigate political backlash. There are multiple planned factories of this kind and a few that are already existing. Thailand is by far the greatest recipient of these investments. Host governments are not passive players. In many cases, they're actively trying to attract investment. This is the case both in Thailand and Brazil, for example. Even in Europe, where imports from China are contentious, FDI is far less so. So far, most investments in Europe and North America are in the battery segment, not vehicle construction. But it is not immediately clear whether Chinese firms will be able to maintain these very low costs and prices when they are operating abroad, especially in regions like Europe with high energy and labor costs. So this all adds up to a complicated picture because growing exports from China create a dilemma for policymakers. On the one hand, Chinese supply chains can help reduce costs. On the other, automotive manufacturing continues to be an important sector for many advanced economies, including the United States. And if production were to relocate to China, this could undermine domestic job creation and potentially lead to deindustrialization. It would also undermine de-risking efforts. So what can be done? I would strongly recommend against trying to slow down the transition to electric vehicles in the United States. Quite honestly, the United States tried this, and it didn't really work. It would also be counterproductive because the transition is well underway globally, and the United States would become even more of a laggard if it tried to reverse this domestically. Instead, policymakers should continue to provide more incentives to advance a diversified and competitive industry and promote innovation, in line with the Inflation Reduction Act. This will require a realistic assessment of supply chains, as well as the trade-offs attached to trade policies. To this end, I recommend that policymakers, 1, identify under what conditions Chinese companies can and cannot play a role in American EV supply chains. To make this judgment, policymakers will need access to better data on supply chains and costs and require more transparency from companies, consistent with recommendations that this Commission has made last year. 2, trade tools can be powerful instruments in achieving de-risking, and policymakers should explore their use, but they should also evaluate their impact on costs very carefully, as they could undermine the industry more broadly. 3, this is not a uniquely American challenge, and there are certainly opportunities to further coordination and cooperation with other countries that are grappling with China's rise in this sector and what this means for their economy. I will stop here and look forward to your questions. Thank you.
Thank you. Mr. Gopal, can you hear us? Are you prepared to testify? Please proceed. Jameson? Mr. Gopal, we could hear you a few moments ago. For some reason, we're not able to hear you right now.
Can you hear me now?
Yes?
Thank you. I hear somebody else talking.
Oh, you probably hear the congressional studio. Could we turn those off, please, so that he is not distracted by that chatter?
So
why don't you proceed?
Oh, good. Can you hear me now?
Yes?
Okay, great. I heard about 3 different people talking at the same time, and one of them wasn't me. Well, let me start off again. I want to thank all the members of the Commission for the opportunity to testify on this. I think it's one of the most important topics and one that impacts pretty much every citizen in the country. So I shall talk based on a supply chain perspective. And that is not a macroeconomic perspective, but I can hear everybody.
Could you describe what it is that you're hearing so maybe we can clear it out? What is the problem?
Should I? Okay. Again, for today, I'd like to lay out.
Dr. Gopal, close your other internet browser window that has the live stream going.
Okay, now can you hear me?
Yes.
Terrific. Let me start off again. Thank you, everybody, for this opportunity. And please let me know if you can't hear me at any point. So I think I'll talk from a supply chain perspective, from a ground level, from an executive level. And Chairperson Glass accurately summarized the situation very well in her opening statement. We've come to the realization over the past few years that driven by pandemic, global conflicts, and events, our critical global supply chains from the point of first supply to the end consumer and back, what we call dust to dust, are highly vulnerable and dependent on China. This is the result of what somebody called willful blindness on our part to the US-China relationship. And let me describe some of that from a supply chain perspective. First, I've heard the term critical supply chains quite a bit. Critical supply chains are all the products, capabilities, technologies, and investments that impact all areas of our national security, defense, health, and well-being. Everything from PPE and antibiotics to defense, to hypersonics, to electric vehicles, and artificial intelligence. And disruption in any one of these can have cascading effects throughout the supply chain and pretty much bring our economy to a halt. So the situation has been driven by several different issues. A lot of them, we talk about the China issue, but a lot of them have been our own doing. For instance, our trade philosophies and globalization assumptions, where we assume the movement of goods, money, people, technology would flow across countries with no government intervention very smoothly, where competition would fuel growth with small businesses, lower our overall total costs, and generate innovation. In other words, the level playing field. What we found is that hasn't happened. The aggressive national supply chain policies and objectives of China, and there are several: market incentives, financial incentives, low cost and stable labor, promise access to the markets in order to become the manufacturing center of the world. We see that very clearly. The coercion of companies to adhere to political and social standards, the acquisition of technology and intellectual property by almost any means available, location in third-party countries to sidestep U.S. and other government policies, and a strong, and this was discussed by the earlier panel, investment and initiative in other countries to corral the supply of essential elements and minerals, which drive our supply chains. And finally, the most obvious one, dumping at low cost. And I think we can agree that these have been pretty successful from a supply chain perspective. And then something of our own doing in this situation, which I call the financialization of the supply chain. Topic and concept highlighted by Rana Forohar in her book Makers and Takers some time ago. Basically, decisions made by individual executives and boards to drive costs down, reduce assets, offshore capabilities, to basically address the benefits to shareholders, not other stakeholders or national security or communities. And is driven by what we used to call short-termism Wall Street demands, as well as executive compensation based on share price. And finally, the concentration of various industries and domination of distribution channels, mainly because of our laxity in enforcing our own rules and regulations. The combination of all of these external and internal forces has been to develop fragile supply chains globally. In other words, supply chains that are built to break under stress. And the stress includes everything that comes at us from the outside. And the characteristics of these supply chains are dangerous choke points in China and other places, which could disrupt our industry, loss of our intellectual property and technology, the loss of our own education system, manufacturing, supply chain, technology, in education, our whole communities, and let's not forget the vulnerability to our national security. But this has not been a surprise. Okay. The dangers and risks have been brought together by this particular commission in 2002 and by forward thinkers such as Barry Lynn in his book, The End of the Line. Let me read one particular extract from the 2002 report. U.S. policy towards China has been driven by narrow commercial interests, specific human rights issues, or particular military and security issues. The increasing transfer of U.S. research and manufacturing facilities to China could have a negative impact on the strength of our technological and industrial base, as well as our relative military strengths. Nobody could have said it better, and this was said 20 years ago. So, hence the term willful blindness. So what can we do to help our supply chain? There are several things that we can do, and I've laid them out in the written testimony, but a brief summary. First, it's a tug of war between national security, between individual wealth and company wealth, and we have to get around that. But essentially, I would suggest we must continue the funding of our U.S. manufacturing and infrastructure. Great start, a lot more has to be done, and it has to be expanded. Critical supply chains are not just semiconductors and not just artificial intelligence. They're everything. We need to help small businesses with financing and help them with innovation. We need to know what we're dealing with, so we need to map our critical supply chains end to end. Very importantly, we need to mandate sourcing parameters and foreign ownership parameters so that we can look at our critical industries not being tied to one country, but maybe reshoring, nearshoring, ally shoring, anything other than stuck in one country with one source. We need to preserve and protect our research and technology through the what the Biden administration has done recently. And we need to do a lot more of that, including restricting access to our technologies, as well as restricting foreign enrollment in our prime technology at our universities. And finally, I have to add this, we have to emphasize and fund STEM and our vocational schools. And with that, I'll stop, and thank you very much for the opportunity.
Thank you, Dr. Gopal. I think, Carolyn, are you there? No. So we'll begin with Commissioner Borokoff.
Thank you both very much for your very interesting takes. From my viewpoint, Dr. Mazzacco, you were very specific talking about EVs, and Dr. Gopal, a much more general look at what's happening and what needs to happen. So it's hard because I can't ask a question, or I'm not capable of asking a question that applies to both of you after listening. So, Dr. Mazzacco, I know that a huge percentage of the EV battery market is 80% controlled by China. Lithium batteries are just their purview at the moment, and yet it's clear that America, if it chose to, could get involved in that in some fashion, and we have immense resources to be able to do that both here and near here. Our EV vehicles are selling extremely well domestically that are made here, and you pointed out not well at all in Europe or China. Given the fact that the batteries are such an integral part of this, is there even a way for us to grow our market? I'm concerned about the domestic sales of EVs. I mean, Ford has a waiting list for their trucks. Their vehicles are in great demand, but they aren't making the batteries. So my question is that a lost cause, or is it something that, in your opinion, can be corrected?
So actually, as a result of the Inflation Reduction Act, there's been a surge in investment in battery supply chains in the United States. I would say what is something to keep an eye on is that a lot of it has to do with the assembly of the battery, so the battery pack, as opposed to the components that go into that battery, right? So the cathodes is really where a lot of, I think 80% according to DOE are made in China. Now, in terms of whether it's a lost cause, I think actually the question is not so much whether they can be made here. I think they can. There are some concerns about cost. I think that's a big one. Environmental costs as well, right? It can be very polluting to refine some of these materials. That's why they got offshored in the first place. But it's also which companies are going to be doing that, right? So I think that's a big concern here, and that's part of my recommendation, is that we need to actually have a better conversation about whether or not to allow or embrace of FDI from China, because it's already happening, right? We already have the Ford CATL deal. We have the Gotion factory in Michigan. And that's because there are no real American companies that are making these batteries at a large scale. We do have, the Inflation Reduction Act facilitated encourage investment from other companies, from Korea or Japan, but because Chinese companies are just so advanced in these batteries, in some cases there's some technology that other companies don't have. Now, I don't doubt, in fact, I'm certain that that a lot of American companies and scientists have the technology to even produce more advanced batteries, but the problem is creating them at scale and at cost. And Chinese companies have just had a lot of advantage. They've had a decade of experience in making these, in part because that's where the market was until recently. They've been selling electric vehicles over a much longer time. So I think it just requires time, and I think it's going to be very difficult to do without foreign investment. And I think, frankly, it's going to be very difficult to do without any involvement on the part of Chinese companies. And now that may be involvement on U.S. soil, and maybe in countries with which the U.S. has a FTA, and in terms of refining or extracting minerals. So I think I think it will be important to maintain that de-risking mentality and encourage more investment in the U.S. or in partner countries. But I think we need probably to have a more realistic assessment of where Chinese companies may be entering and where that is more of a risk or not. Because I think in some cases it may not be as risky as in other situations.
Thank you for that. I would point out that a man from America who just passed away, Dr. Goodenough, who won the Nobel Prize, invented all of those, and recently has invented, just before he passed away, batteries that he thinks will last effectively for decades. And we gave that away to a foreign country because we wanted to save money on construction and manufacturing. So it's unfortunate we did it that way. And we have about 20 seconds left. Dr. Gopal, if you can pop in and pop out, if you're interested.
I certainly am, sir. Thank you. I agree with everything my colleague said. But looking at it from a supply chain perspective, which is the perspective I always look at things from, the upstream end of the supply chain is at risk. In other words, lithium, cobalt, nickel, all of those minerals are things we don't control right now. I'm not saying that we couldn't have them here, but that will require not only investment, but a lot of political will about mining and so on. But right now, we are busy building the front end and the downstream of electric vehicles. And it's the upstream that's really the concerning part of it, because we don't own that. A lot of that is controlled by China and Chinese companies. And it's something we're going to have to work around and discuss.
Thank you very much.
Thank you, Commissioner Borokoff. I'm next. So I'm interested, Ms. Mazzocco. You talk at length about the approach to evaluating supply chains must be broadened to include the supply chains, products, capabilities, materials, and technologies that impact health, PPEs, antibiotics, active pharmaceutical ingredients, food, renewable energy products, aircraft and automobiles, amongst others. Is it really possible for us to determine a definitive list of what comprises critical items for our supply chain? Or is this a fool's errand?
I believe that wasn't my statement, but I can comment on it. Yes, I do think it's challenging to identify what is critical. I actually think it is important to identify what is critical, because otherwise everything becomes critical. And so I would actually encourage to have a very narrow view on what is actually, for example, a national security threat, as opposed to just something that may threaten certain elements of the economy, right? And I think, for example, when it comes to the electric vehicle industry and batteries, this is very important from an economic standpoint. I think it has very big implications for the political economy. I think national security-wise, the implications are far less concerning. And so I think, for example, here, that doesn't mean that one shouldn't take action, but one can take action in different ways, right? And so the types of risks that are involved are different. And so that's part of my recommendation, is to take a very clear stance in identifying what exactly the objectives are and how to act upon them. So, for example, cooperation with partner countries can be far more effective, I think, when it's not a national security concern. And I think there may be certain flexibility when it comes to allowing certain types of companies perhaps being involved in certain levels and certain elements of the supply chain.
Thank you. Dr. Gopal?
Yes.
Is it possible to establish a definitive list of what is or is not critical?
I believe it is. But let me back off a minute, because that was my statement you read. And what I meant. We have to look at criticality, the things that will seriously hurt us if they're disrupted, along a number of fronts. This does not mean the things that will seriously hurt a few companies, a few investors, things like that, but seriously hurt the country. And the second part of that is, what are the risk profiles of these things? So a critical supply chain may not be something we want to focus on if we can recover from disruption really quickly with our allies. A critical supply chain is something we have to focus on if it will take a lot of time and money and effort to recover while the economy is being hurt. And there are several of those. It's not an inexhaustible list. It's a fairly short list, but it has to be looked at both from the point of criticality and risk.
Is there any evidence that in these items that you have identified, at least as a preliminary list, is there any evidence that the United States is taking action to stockpile either critical materials or items that you view as national security risks?
I believe in the defense arena, yes. But otherwise, I don't see much of that from the point of view of private supply chain companies or even the government. And I'm hoping we don't actually stockpile them, but we build the capability to manufacture and get them out, which is the better way of doing it.
Well, like the strategic oil stockpile, I'm not sure I agree with you, but I also don't think that we should stockpile everything. But if we do believe something is, as you characterize it, both at risk and necessary, it would be interesting to see if there was any effort to map to stockpiles. Commissioner Friedberg, are you there?
Thank you very much. I had a question. I'd like to pose one question for each of our witnesses. Dr. Mazzocco, you started off by making the point that this forthcoming flood, you didn't use that term, but of low-cost Chinese electric vehicles could undermine the efforts of the United States and others to build up their own sources of production and supply for the components of these vehicles and for the vehicles themselves. So my question to you is, will it be possible, in fact, for other countries to catch up with China, to build up their own industries, the EVs, the batteries, and so on, without imposing some kinds of restrictions on imports of these products from China, and what are the implications of that if it's true? Dr. Gopal, you used the very interesting term, a supply chain war, which I think is a good way of describing what's going on. In a war, of course, you have two sides, and each is pursuing its own interests and objectives and has its own strategy. And China seems to have a pretty clear strategy of trying to reduce its dependence basically on the West for various things, while doing things to maintain our dependence on them. And so my question for you is, what are the implications for U.S. and sort of wider allied strategy of the strategy that China is pursuing, essentially to try to prevent us from reducing our vulnerability and dependence? Because it appears now as if we don't really have much of a strategy. We have private sector actions, government action in a few narrow cases, but no overarching strategy. So, Dr. Mazzocco, first to you.
Yes, thank you. That's a very good question. I would say currently most countries do have some level of protection when it comes to the automotive sector, right? We have 27.5% tariffs right now in this country on Chinese imports. In Europe, it's much lower, and that's why we're seeing more imports from China. I think it's around 10%. So these already exist. So I think it's more of a question of whether they should be increased or changed. I think in reality, what needs to happen is some sort of balancing as towards the trade side of things and also the attracting FDI level of types of policies, right? So on the one hand, there needs to be far more investment domestically to build up manufacturing, and on the other, there needs to be a maintaining of certain level of tariffs, right? I'm actually not suggesting to increase tariffs, but I think reducing them would probably not be ideal. I do think there is a risk of overcapacity in certain countries. I think that's basically where we're headed towards in China. I think that's part of the issue, is that we're going to see more exports because of that. There is a question, though, whether these companies can keep it up, right? I think in some cases, many Chinese companies are actually operating at loss. So that's something to keep into consideration.
Thank you. Dr. Gopal.
Thank you, sir. So what I'm about to say probably makes me unpopular with a lot of my colleagues, and that's okay. Yes, I don't believe we have a national trade strategy, and I believe we should. It should be based around economic well-being, our long-term sustainability, and our national security. We don't have all of that. everything is in bits and pieces. And a lot of our national trade strategy is subject to individuals and individual companies, individual industries. So, for instance, we talk about auto tariffs and we talk about some restrictions on technology, yet our major companies are giving away our IP to China, building factories in China, working with the Chinese to circumvent any restrictions. And we don't have any policy as to what defines sourcing, ally sourcing, friend sourcing, reshoring, any of these things. So, sir, I do believe we need to have a national trade policy that addresses all of these and that addresses it from a national, not an individual or industry point of view. And I hope that answers your question.
Okay. Thank you very much.
Thank you, sir.
Many thanks to both of our witnesses for coming before us today. You know, I have a few questions. It sort of dovetails from panel number one. So what we know is there's fragility in the Chinese economy that has created a lack of consumer confidence to the same extent it used to exist in China, lack of consumer spending. We've got party official who is trying to stabilize and paint a different picture on the world stage, masking what is really essentially a recession happening in China and its implications to the world. So I'm trying to think about supply chains in that regard. Lack of consumer spending, looking at export markets, secondary markets to the U.S. economy, investing in other markets to gain access to the U.S. economy as a workaround to the current trade rules that exist, including the Section 301 tariffs. And I lose sleep at night in terms of what are the implications to U.S. manufacturers and service providers, because the Chinese government, its party, its officials are doing everything they can to help prop up industries right now. And to what extent, I know we've talked about EVs quite a bit during this session, and we have an EV expert here, but what are the implications longer term, and do we have enough trade tools in our toolkit to address what could be a very severe economic harm both to the United States economy and to our allies? And that's my read on the situation. So please disagree if you have a different perspective.
I'd like to just jump into that quickly then. And yes, I completely agree with you. From a supply chain perspective, what we are looking at across the ocean is not what economists look at. We're looking at an economy in China that's going down slightly, consumer spending is down, but the capacity is still there. So what have countries traditionally done with that capacity? So we're looking at dumping. We're looking at dumping low cost, lower than cost items in our markets, either directly or through subsidiaries located in Mexico or in other places, or through other companies that are controlled. But we're looking at that sort of thing. And the only way I think, well, that's one of the major issues. The way we can handle that is through our restrictive laws as we have it about dumping and things like that. But that is a serious, serious concern. Meanwhile, there's going to be no let-up in the Chinese attempting to take our technology because of their development of defense systems and their own military capabilities. So they will buy stuff. So I see no let-up in the degree of competition in the supply chain world with those developments in China. Over.
Yes. right? This is clearly something that's very concerning that the U.S. should be keeping an eye on. I spend a lot of time thinking about clean energy supply chains, and there the dilemma is particularly acute, I think, because on the one hand, this is an industry that the U.S. does not have a handle on, right? This is an industry that we're trying to develop currently in the United States, and similar efforts are underway in other countries, like in the European Union, for example. And even in some developing countries like India, for example, right? They're trying to develop their own clean energy supply chains. But at the same time, costs are continuing to fall in China, and so we continue to see exports. That's not a bad thing in terms of consumers globally, right? There's access to these technologies, but it's not good from a perspective of our domestic economy and de-risking, which are all pretty important targets. So it creates this big policy dilemma that I've been talking about. I don't think there is an immediate panacea. I don't think there's one trade tool that we can point to that can solve everything. I do think there needs to be far more thinking about this and needs to happen fairly quickly. At the moment, there are none of these, the flood of Chinese EVs has not happened in the U.S., but, the cost is so low that eventually a 27.5% tariff may not be that big of an obstacle. That may not be, this might take some time. It may take very little time. We don't know. But I think there needs to be a lot more creative thinking about different types of tools that can be utilized. I do worry that cost is going to be a very big concern because that's typically what trade tariffs do, right? They raise costs. And once these products are not competitive, there are alternatives to these, which are fossil fuels or traditional automotives, the traditional automotive industry, which then undermines the broader transition, which makes the U.S. less competitive and less innovative, right? So I think there is a bit of a, there's a lot of juggling that needs to happen in this.
Thank you.
If I can just say a couple of sentences on that. I agree with everything Ilaria said. That's terrific. I'd like to point out another implication of this. Reduction in costs in other countries leads to our own costs being, quote, uncompetitive, which in the past, because our executives are compensated on share price, and we have some short-termism in what we get from Wall Street, will lead to increased outsourcing and offshoring of critical things, which in the past has led to hollowed out communities and everything else that we talk about. So this is an issue that we need to look at from a nuanced and multifunctional perspective, not just the economics of it. Over.
Thank you.
Commissioner Goodwin.
Thank you, Madam Chair. Dr. Mazzocco, in your testimony, you indicate that attempts to completely insulate us from competition is not the right approach, and instead continuing to pursue incentives to advance our domestic manufacturing capacity and encourage investment in EV supply chains like the IRA is the right approach. And you recommend then what we need to do is identify under what conditions Chinese companies can play a role in our EV supply chain. And I wonder whether the IRA and some of the specific investments you referenced in your testimony raise a separate question, which is under what conditions should Chinese companies be allowed to directly benefit from the financial incentives and consumer subsidies in place to encourage EV production here in the United States?
So your question, excuse me, the question is under what conditions they should be able to benefit from the incentives?
Yes, and do you see that as different from the way you framed it, which is whether, under what conditions should they be able to participate in supply chain? And, the difference is step back and consider under what conditions should they be able to actually access the financial incentives and benefits that we put in place to encourage investment in EV vehicles here in the United States?
Yes, so I think my recommendation stemmed from the fact that there has been a lot of unclarity and a lot of confusion over whether these companies should qualify from subsidies in the United States, for example, and also from the fact that there has been increasing investments on the part of Chinese companies upstream in countries that then would qualify under FTAs for supplying critical minerals for the production of batteries that then would qualify for subsidies, right? So I think the question is not, my question, I guess, or the question I raised is not so much that I don't necessarily have the exact conditions at hand, because I think they really depend on the segment of the industry, on the industry itself, and then on the companies themselves as well. But I do think it's worth raising the issue that we don't necessarily, it doesn't seem to me like we have a very clear framework of how to deal with Chinese companies as they internationalize. So that's what I was pointing to in my recommendation. I don't necessarily, I mean, I think if the two companies that we're talking about qualify, if they are meeting the legal requirements to be in the United States, then there's not much, I can say or do to say that they shouldn't be here, right? And neither can anyone else. But I think if policymakers think it is risky based on data, then they should certainly amend the legislation. I haven't seen anything that suggests to me that these companies are a risk to the United States. I think they're helping expand capacity, but I may be wrong, right? I may not have access to all the documents, and I think that's part of the issue here is exactly what types of investments we're talking about. I do think, though, that it's going to be unavoidable that we're going to keep seeing these questions coming up, and I think we need to just have a very clear framework. I think this is also going to be very helpful for American companies as they engage with Chinese companies to know what they can and cannot do. So I think there should be more of a clear framework on this sense. I hope that answers the question.
Sure, thank you. Dr. Gopal, do you have any thoughts on my question?
Yes, it's the same thoughts that I had on the previous one, sir. And that is, we have to decide when we look at investments and things like that, what our key priority is. Is it national security? Is it our own jobs and economy? Or is it the proliferation of one particular industry? And with that in view, I think, as Ilaria pointed out, we have no specific framework with which to analyze Chinese companies working in here. But we never need to forget that the long view that the Chinese government takes is not necessarily how do we get the best EVs or green technology in the US. It's how they can profit by this over the longer term. And given that, I would say there's a lot of issues in allowing Chinese companies at this stage to be part of the spending, that infrastructure spending that we are talking about right now. I think we have to look at that very carefully. Over.
Thank you.
Thank you. Are you finished, Commissioner Goodwin?
Yes, thank you.
Thank you. Is Commissioner Hellberg there?
Yes. Thank you to all the witnesses for insightful testimonies. I wholeheartedly agree with one of the testimonies that too many parts of today's global supply chains were built to break and without any regard for national security. China's accession to the WTO was, in my view, one of the greatest single American foreign policy miscalculations in U.S. foreign policy history and fueled the rise of a hostile geopolitical adversary, the likes of which our country has never faced. But we are where we are. My question is addressed to all witnesses. If you could wave a wand and get the administration or Congress to do anything, what specific types of bills or executive orders do you think the government could take to administer a shock therapy to revive our manufacturing base and secure our independence in critical raw materials? Maybe we can start in alphabetical order with the witnesses.
Okay, I don't know if I come ahead of Ilaria on this one, but my first names we do. I think, sir, that if I could wave the magic wand, I would have a few different things that we have to do, and none of them are surprises or anything else. Number one, I would increase our funding of U.S. manufacturing infrastructure and the scope of it to build up the capacity we have lost. Number two, wave of the magic wand, we're having a few of these, would be to look very closely at the critical supply chains and, yes, impose some restrictions on who can buy into them, who can invest into them, and how we can protect them, both from the point of view of the supply chain and the technology that accompanies the supply chain. Third, I'd provide, with my wand, sourcing parameters that I would require our companies to look at and adhere to in terms of different products and industries as to where they can source, how much of a percentage can they source from a particular country, what their distribution is, what their diversification is, and what their regionalization of the supply chain should be. And finally, I would hit the education front, where we've lost a lot of talent, where we've lost a lot of research, we're desperately short of STEM talent, and we need to emphasize and fund those programs. Thank you, sir. That's over.
And Mr. Goebel, before we move on to the next witness, what types of infrastructure funding do you view as being particularly contributive to manufacturing activity? Is it transportation as infrastructure, energy infrastructure? I'm curious if you're thinking about specific types of infrastructure that needs to additional funding, or are you referring to infrastructure as a whole?
Specific types, sir. Specific types. Firstly, transportation. All modes. Air, road, rail, and ocean. Ocean transportation is now controlled by a few companies, and that's a capacity and risk issue. Secondly, digital infrastructure. 5G, internet, satellites, global positioning systems, and the cybersecurity that supports them. That's the second piece. And thirdly, you brought us energy. I have no answer to the energy, nobody does, but I do know that we have to be practical and see what energy our industries need to be competitive, as opposed to telling them they should do this or the other thing. So those are the three issues that I would look at.
Thank you very much.
Thank you. I would agree on the R&D and education piece of that Dr. Gopal outlined. I would actually increase R&D in efficiency, efforts to improve efficiency on the usage of these minerals. Recycling efforts, there's a lot of potential there as well. Alternative chemistries for a lot of these, batteries, for example. I think all these could then, certainly the research side of it could have more investment, but I think especially there should be a framework to help them commercialize, which is where China has really excelled and the United States has generally lagged, right? We generally have very strong research in American universities, and that doesn't necessarily get commercialized or produce a skill in the United States because that piece is missing, right? I know I'm talking about something that you're all familiar with. The second part is that I think there's a potential for more, and I think this is already happening, but it could be, I think, enhanced partnerships with other countries and collaboration and in seeking ways of, enacting de-risking. It just cannot be done only in the United States, right? I think autarky is neither desirable nor achievable in this sense. And then third, I think, the permitting reform conversation is the one that's important, and that's already undergoing. It's a complicated one, but obviously that moving that forward would be important.
Thank you.
Commissioner Price.
Great. Thank you both for your participation today. Several of my questions have been answered in part, so excuse me if I'm a little redundant. But before I get there, Dr. Gopal, In your recommendations, you talk about mapping of critical supply chains. My first question is, do we have the data that would allow us to do that? Number two, what already exists? And number three, we don't seem to have a whole lot of time. How long does something, when you came up with this idea, how long were you thinking this would take to do, and how do we implement? So why don't you go ahead, and Dr. Mazzocco, you can add in if you'd like.
Thank you, ma'am. Let me start with the last one first. How long do I think this would take to implement? I think no more than 6 months. This is an exercise that requires a lot of thought, but not that much data, because let's just take a simple one of semiconductors, the different types of semiconductors. We know it's critical. What are the industries they go in? We can get that from the semiconductor industry. What are the industries that depend on those? So semiconductors drive computers, defense, all of these, which in turn drive airlines, tourism, information technology, and all of those, which in turn drive a whole lot of other things. I think we can map the cascading effects. The key here is mapping the impact. And that will require some modeling rather than much data. But I think that can be done fairly quickly with a solid task force. And I don't believe it should be made too complex, because complexity is always the enemy of action. And I think it should be made understandable and fairly simple, so that you folks in the Commission and the government can prescribe actions to work with the front end of those, the critical supply chains. I hope that answers your question, ma'am.
Do you think we have the data that we need, though?
I believe we do.
Okay, thank you. Do you have anything you'd like to add?
My sense is that a comprehensive analysis and data collection effort on the critical and upstream side of critical materials would probably be, it would require some effort in collecting all the data, putting it all together. I don't question that the data is out there. I think finding it and making sure it's up to date and actually understanding what is happening on the ground. I think in many cases the mining is happening in countries that might not have very good data. I think of the cobalt industry in the DRC, for example. There are, understanding which mines are open, which ones are, who is relying on artisanal mining, right? I think, there are efforts there, and there is definitely data out there, but I think it might take, from my perspective, it might be a bit complicated by that. But that might not be what Dr. Gopal is suggesting. I do think it is important to have a sense of all the players involved. That might not be, completely comprehensive, but I do think my sense is that there is quite a bit of confusion at the moment due to not very good data on exactly which types of Chinese companies are involved at which levels of the supply chain, and which foreign companies and what type of foreign investment, non-Chinese companies are also involved in those, and who are partnering might be in some points with the Chinese companies as well as what the host governments are doing and how much they control some of this, the supply chain as well.
Thank you. Dr. Gopal, on one other question on clarification on the the recommendation you have about talent. Just a few minutes ago, you also said something about we need to restrict foreign enrollment. Can you clarify what you're talking about?
Absolutely, ma'am. So let me start from the top. Our universities today are getting increasingly dependent on foreign students, Chinese students, who pay full tuition. That's point one. Point two, there are disciplines that the government pays for research, that the universities do, that are critical to our national defense and to our economy in some ways. we have to vet seriously the students who we allow to enroll in that, so that this is not a revolving door and a straight pipeline back to China or Korea or Russia or wherever of our technology and the research. And as Ilaria pointed out, coupled with that should be the ability, and how do we apply this and take it commercial and take it to use. So yes, the answer is we have to look at who we have enrolled into many of these disciplines in several of our universities and take a good hard look at that. Over.
Thank you very much.
Commissioner Shriver.
Just add my thanks to the witnesses. I think most of my questions have been addressed, so I'll pass.
Thank you. Commissioner Wessel.
Thank you. And Dr. Gopal, I appreciate your recognition of Rana and Barry's work. They've been toiling in this field as you have for many years. You referred to and used the term willful blindness, and I appreciate your recognition of the long-term work of this commission. But I would argue to you that willful blindness continues to cloud visibility as to many of the challenges we face. Recently, in appreciative of the work of the administration on an outbound investment executive order, it is still limited in terms of providing us the data on critical supply chains, batteries, pharmaceutical, et cetera. We have existing U.S. authorities that this commission has referred to in the past. For example, it's the Department of Commerce, the power to compel any multinational business doing business in the U.S. to respond to questions. That could be used to provide us data on supply chains, whether it's in batteries, critical minerals, materials, aerospace. And you serve on the Defense Business Board, which I think has mostly been focused in the last couple of years on talent pipeline issues. But what new tools in terms of transparency and data do you think would be needed? Dr. Mazzucco, for you as well, I think, for example, Ford's efforts with CATL on Blue Oval, don't fully identify what's happening in the battery supply chain and the IP that is being utilized there. How do we get the data in a granular sense when business has been opposing, any of those data transmission efforts? Dr. Gopal, do you want to start there?
Yes, sir, I'll start. You've posed the question of the decade. In an economy like ours, how do we get business to help with the national profile? And we've seen what's happened in the past. The only way I can think of, from a purely simplistic view of an executive, is mandating the data, making sure that the data is going to be highly confidential, the security of the data, but in effect, mandating the data. And secondly, sir, it's looking at data as a tool and a weapon, because that's what it is. The warfare of the future is around data. So just not going overboard with asking every type of data, but asking for the little data that matters where we can make our decisions. I know that's a iffy-wiffy way of putting things, but it's actually true. We have so much data. We need to specify specifically what we need from companies so that you folks can make your decisions on criticality and policy. So it's focusing on the data and what data we have, because the data is there, the transparency is there. We need to focus on the what.
Let me pull on that if I can, because again, you're a member of the Defense Business Board, which has leaders of industry from CFOs to CEOs and otherwise, all of whom depend on data to make the right kind of decisions for their businesses. Should that be a higher priority at DoD in terms of supply chain transparency and transparency in a BPI sense? I don't mean that it has to be fully expressed, but you know, we don't know where all the critical minerals come from or where the processing facilities are. China just became sold its commercial jets, the C919, and is going to be making further incursions into aerospace. What would you, as a business leader, need? And you can do this as a follow-up. And are you seeing enough within the defense establishment to be able to get the kind of data that's needed to make those decisions?
The short answer says yes, certainly. Everybody recognizes the data, the need for data, and what we call the infrastructure that the data needs. And yes, we may not have all the data you're talking about as a country. I don't believe we do, or as companies. But yes, I think we're on the path to getting that. But I still think that from the private sector, we need to mandate the turning over of the right type of data, and because they collect it.
Dr. Mizuko, a quick response.
I think it's a very broad question. I appreciate the challenge there, and I think there's different parts to that. I think, to be honest, if I have to pick something, what concerns me more is lack of transparency on Chinese companies. I think in the previous panel there was discussion about poor access to economic data in China. So if something that I would focus on, which I do think is data that is going to be increasingly hard to get, is the actual Chinese supply chains, and what which companies are operating in which sectors and their background when they're, for example, doing FDI in the United States. Something that I think came up with CATL, for example, recently. So I think that's one thing to focus on. That's probably going to require a lot of external research, auditing, and perhaps even some level of a high-level dialogue with China, right, with the Chinese government, because this is obviously part of an ongoing challenge there that may be undermining American and companies in the United States, in China, operating in China as well. So that's one piece of it. I think the other piece is, I think you mentioned IP. In the CATL4 deal, I cannot speak to that obviously, but I do think that's an interesting point, and that's, I think, points to something that indicates a reversal of previous concerns in the United States, where that American companies were giving away IP to Chinese companies, but now we are much more concerned about Chinese companies actually providing access to their IP to American companies. I think, again, that's something that should be explored and should be clarified in the legislation. Right? I don't think there is any requirement for CATL to give its IP to Ford, for example. So I think if that's that's identified as a real challenge, and that's something that should be clarified, as I mentioned before. Right? There's identifying actual goals and what companies can and cannot do in the United States is probably important. I think that's all there's time for. There's a long conversation. I'd be happy to have it at another point in time if there's more questions.
Thank you.
Thank you. Commissioner Wong, do you have questions?
Yeah, Dr. Mizuko, thank you for your testimony. I'm just having, I don't know if you have it at hand because I'm having trouble finding the actual number, but what is the current Chinese tariff on U.S. auto imports?
I can't remember it off the top of my head right now. It's significant.
Yeah, I remember they raised it to 40% at some point in 2018, and then there were some reports they were going to lower it, but I'm not sure if they ever did that, and if it was a part of the phase one. I just can't remember. But suffice to say, I think there's at least still a 25% tariff on U.S. autos in China. There had been a long time disparity between the tariff we had placed on Chinese auto imports before 2018. I think it was like 2.5% before we raised it to 27.5%. But this goes to my question. I mean, would you agree with me that the Chinese advantage in EVs came out of a combination of a number of policy choices? One are the subsidies, the purchase subsidies you mentioned, which were tens, if not hundreds of billions of dollars. Second is protection through tariffs of their market, which is the largest automobile market and largest EV market in the world. The U.S. is second. Number three, lower environmental standards, which allows them to refine and mine critical minerals at a much cheaper rate, as well as lower labor standards. And I think importantly, at least at the beginning of the EV industry in China, the theft of intellectual property from Western companies, and particularly American companies. Are those factors correct in what has built the Chinese advantage?
I think, yes, they all played a role. I would say also they came at the right time. Right, I think these policies were initiated around 2010, and by 2015 we started seeing the technological advancements in a lot of these areas, and at the same time Chinese consumers were really interested in EVs, which is something that, to be honest, I don't think many even predicted in China. So I think there's a convergence of various factors, but I think the ones you mentioned all played a role. I would say that the tariffs into China probably were especially significant in ensuring that companies invested domestically in China to produce capacity. Certainly, I think that was the case for Tesla, for example. And one more thing, I think, to qualify for subsidies in China, the vehicles had to be produced in China.
Okay. And if I'm not mistaken, I think the tariff levels between the United States for a long time, between the United States, the tariff levels that China applied to the United States versus those they applied to European cars, they actually had higher tariffs on U.S. cars for a long time, and I think still do. Am I right about that?
I actually am not sure. I'm sorry. I don't have that data at hand.
Yeah, we'll research that. That goes to my question. I mean, would you agree then there's kind of I think there's clearly a strategic valence or a strategic impetus behind these policy choices. Namely, it seems that there's a conscious decision by the Chinese to develop, obviously, an industrial leadership position in EVs, but in particular to build dependence throughout the Western world, including in America, on these technologies, but also to undermine the U.S. industry. Is that correct, or would you disagree with that?
I would say that when the policies were first launched, the actual focus was to reduce China's dependence on foreign technology. So this was very this was very clear. They identified a technology that where Chinese companies stood a chance to compete more directly with Western and the non-Western foreign automakers. Since I think basically since the 1980s, there had been several policies in place in China that aimed to do that and had completely failed in the internal combustion engine vehicle industry. So, for example, the reason why there's so many joint ventures between foreign companies and Chinese companies is because that's mandated as an effort to help Chinese companies upgrade, and that never really led to their advancement in the industry. So by shifting towards electric vehicles and investing in electric vehicles, the hope of the Chinese government would be that a more, obviously we've talked about how it's not necessarily a homegrown industry, but a homegrown technology, but a technology that was developed further in China and where supply chains could be more controlled by Chinese companies would reduce their reliance on American and European and Japanese automakers. So I would say that's most certainly what happened initially. I think as the time progressed and as the industry really took off, and I should note that I think based on my research, when these policies were first launched, they were fairly obscure and not necessarily something that most of the Chinese government was focused on. But after a few years, they really took off. The market was really developing, and I think that's when we see more of an understanding of the potential of this industry as an export industry. And I think certainly now, I'm sure there are considerations about how this could be increasing foreign dependencies on China in line with dual circulation. But I don't think that was the case originally.
Okay. I appreciate your answers and the suppleness of your research. I just think a lot of these factors we'll have to consider, and I am very worried and question the wisdom of what I see as the current trend in the United States of adopting policies that essentially dovetail with that strategic impetus of China, namely subsidies for purchases of EVs in the U.S., outright bans on internal combustion engines, and either bans on or extremely difficult permitting processes for mining and refining here. That would seem to back us right into the strategic pocket of what the Chinese are trying to do in the EV industry. I think we have to take a very strong look at that. But thank you for your testimony.
Thank you to our witnesses. This is the last hearing of unless somebody else has some burning issue. This is the last hearing of the year. We will begin, we are in the process of wrapping up the annual report, but we very much appreciate you coming and offering your observations today. So with that, the hearing is adjourned.